Right, good morning. Can you believe it? In Pretoria, we are actually off to an early start. Well done. Right. Nice frisky morning here at the capital in Pretoria this morning in February. Good morning to you all, and thank you so much for coming through. Really good to see so many familiar faces and some faces I'm not familiar with. So thank you all for coming through and joining us. And a great thank you for all our presenters here today as well, taking the time to come out here. And obviously the time you took to build your presentations and to entertain us for the day. I'm sure we're going to have some good jokes as well, but we'll see as we progress. Before we get underway, just a couple of quick house rules. Make sure that you scan in and out. You know the story for CPD points. If you haven't scanned in yet, the QR codes, if you can maybe just flip to the QR codes, are on the screen now, so please do that. Very important, if you leave, please scan out as well. I've got a very old phone. It looks like an iPhone, but it's not, but it doesn't scan QR codes. If you have problems, you can speak to the ladies at the back as well. All the presentations for the day will be made available on the Boutique Manager's website. We are recording the session this morning as well, so we will share that with you at the end of all the roadshows. From Robert Walton, Tanya, Amelia, Olga from Cape Town is here as well. And from the entire BCI team, thank you for your continued support and making BCI an absolute great success. Let me use this opportunity to welcome one of our new members, Kim Rousseau, who joined us recently as Chief Executive of Client and Strategy. Kim brings with her a wealth of experience in fund administration, CIS world, as well as the hedge fund world, and a lot of experience in the discretionary fund management world as well. So Kim, if you can just stand up quickly, everybody can see you exactly who you are. She said she's not going to speak today, but we are going to make you speak next time. Right, Kim, thank you. Welcome aboard as well. The session here this morning is all about you and your clients. We do this for you. We've got a really good lineup of presenters today. They went through a lot of trouble to make sure that they can cover most of the important topical stuff that your clients typically ask you all about every day. We encourage you to ask questions to any of the presenters. We did allow, as per usual, about 5 or 6 minutes after each session for questions. I think the room is small enough. I don't think you need a mic if you want to ask a question, so just put your hand up and ask, and we'll cover that as well. 2023 was quite a reversal of what we expected this time last year. This time last year, most anticipated recession that never came. We all know about it. And end of Q4, an extremely strong rally, and with lots of talks of optimism on a soft landing for what it's worth. You have to ask that markets get ahead of itself at the end of 2023, believing there's going to be more rate cuts than what the Fed is actually signaling. The US consumer last year was powered by excess savings in the system, and it seems to be winding down at the moment. But that said, the US still have a very strong labor market and solid wage growth, although not good for inflation, but it can maybe keep the party going for longer. Is it finally time that we can stop worrying about inflation, or is it too early for central banks to actually call a victory? We've recently seen in data that inflation can potentially be stickier for longer. Lots of news flows still around China and the opening of stimulus packages in China. We know about the property crisis they are facing, but some still hoping that that can maybe prop up some of the global slowdown during 2024. We'll have to wait and see, and maybe we can address this as well. Economies like the UK and Japan already in a technical recession, but yet the Nikkei 225 is at an all-time high despite that technical recession. Crazy world we've got here. Markets, I think, and the most important for me, are not pricing in any bad news. But what if earnings were to disappoint somewhere in 2024? We all know developed markets are expensive relative to emerging markets. A lot of questions around emerging markets, geographical allocations, and especially to SA equity. We're going to talk a lot about SA equity here this morning. Well priced, but is there a reason why SA equity is so well priced and look attractive? We all heard about the challenges that our economy faces last week and Wednesday. and for a lack of better words, the logistical blackout in South Africa. How will that impact on SA companies, or more specifically SA equity? If anything that we've learned in 2023 is a caution not to construct portfolio based on forecasting. We've all seen how miserable everybody gets forecasting wrong and trying to call macro events and construct portfolios around that. It just simply doesn't work. Needless to say, 2024 is going to be bumpy, like any other year. All right. Every year is bumpy. There's always events every year. And I very often tell that to investors as well. You know, when there's an event, they all get panicky. There's events always, every year, there's something going on. The most important, I think, is finding the right manager and employing a skillful manager for your clients to navigate this world. On stage already, this brings me to our first speakers of the day, Chris Holdsworth and Barry Shamley from Investec. Thank you so much for coming through this morning. I really appreciate your time and looking forward to your presentation. Thank you.
All right, morning everyone. My name is Chris Holdsworth. I'm responsible for certain parts of our investment process and investment strategy at Investec Investment Management. My colleague over here is Barry Shamley, who's a fund manager. What we're going to do over the next 20 minutes or so is spend about 10 minutes, we'll be very brief, on the global macro environment and what it means for stock selection at this point in South Africa. And then Barry's going to run through a couple of opportunities that we're currently taking advantage of in the local market. So we're going to start off with a very brief description of our business. We've been around for a little while. We've been flying under the radar within Investec. We've got 15-year track records for a number of our funds. We've got about 250 billion rand under management, and we've got about 25 funds or so across multiple asset classes, local and abroad. So we are a fully developed asset manager with a sizable staff complement. This is just our equity research team alone, along with 2 individuals involved in investment strategy. Collectively, amongst our equity research team, we've got about 200 years of experience. Some of our team is based in the UK, some are based in South Africa. We believe if we're going to invest in companies offshore, we need to have feet on the ground offshore. So it's 200 years amongst our research team. That ignores our portfolio management team, where there's probably another 200 years worth of experience or so. And our portfolio management team is based, again, in the UK, Switzerland and South Africa. UK and Switzerland largely responsible for some of our direct holdings offshore in South Africa, while investing in South Africa and some asset allocation more globally. So that's very briefly who we are. Where are we at the moment in the cycle? Just following on from what Eugene said, I think we can make a very strong case for us currently being at the back end of the economic cycle. And we can see it in a number of different measures. If you look, for example, at credit card defaults in the US, you'll see that for smaller banks they're at the highest level that they've been ever on record. Even for large banks, you can see how it's picked up. And there are a range of other indicators we can look at too, which suggests that we are somewhere near the end of the economic cycle. Our preferred measure is to simply look at earnings. And that's the chart on the left. This shows earnings relative to trend for the S&P 500. We've got it going back around a decade or so. We could take it back another 90 years if you want. Earnings follow a fairly regular cycle around trend. And earnings have been above trend for a while. And normally when earnings are above trend, you're due a correction. And we've seen that in part in the US, earnings growth over the past couple of years being tepid at best. And we expect that earnings growth is likely to be quite weak going forward too. Now, we wouldn't mind that if the US market was cheap. We can accept earnings growth being single digit or lower if the US was on a forward PE of 10. But as we know, it's not. It's on a forward PE of 20. The historic PE is about 22, trades at about a 15% premium relative to history. So we've got a combination of earnings which are extended, we're at the back end of the cycle, and valuation which is extended too. And that by itself would give us reason for caution. But there are a few other reasons too. As we all know, it's a pretty volatile world at this point. It's elections in a lot of countries across the globe. We track what's happening in the US election fairly closely. The best way to do it is through the betting market. The outcomes from the betting market have been much more accurate in forecasting elections than polls. So we spend some time having a look at the betting market. It's not for betting. We've got compliance approval to do this sort of stuff. Anyhow, if you look at the betting odds at the moment, Trump is a marginal favorite, looking at about a 45% chance of winning. Biden's at around 40%, and then there's a few other candidates that make up the rest. It's moved around a lot. The issue for us is we've got the policy proposals from Biden. We know what he wants to do if he comes back in power. It's all stated. Not a lot of it is good for markets. Higher taxes, capital gains tax, company tax, personal income tax. For Trump, we don't know. He hasn't published what his policies are. He might not publish them at all, even after he potentially wins. The point out of this is that there's a huge question mark around fiscal policy next year, which makes the world a little more uncertain. While that's happening, we've got all the geopolitical uncertainty too. You've got the war in Ukraine, you've got the war in the Middle East, and this chart on the right shows a knock-on consequence for global trade. This is the number of ships passing through the Suez Canal, the number of container ships, which we track pretty closely. You can see it's down around 80% year on year. And the net result of that is that we are already starting to see an increase in global shipping costs. Global shipping costs on average are up around about 100% year on year at this point. There's some routes where they're up 150% year on year. And we know when shipping costs go up, it leads to high goods price inflation. And we're just starting to pick that up in the data now. We probably need to wait another month or two for it to become entrenched. So now, just to add to the uncertainty, we don't know what's going to happen to inflation next year because of what's happening to global shipping routes. So we've got fiscal policy uncertainty because we don't know who's going to be the president, and now we've got monetary policy uncertainty too because we don't know what's going to happen to inflation, and as a result, we don't know what's going to happen to interest rates. Just a final point on the US before we switch over to South Africa and what it means locally. In addition to all of what I've just mentioned now, we're only finally starting to observe the knock-on consequences of the Fed hiking rates by over 500 basis points. The reason it took so long is over 90% of homeowners in the US fix their mortgages at very low rates. So the Fed hikes, it doesn't affect their monthly payments. But it does affect the payments on your credit card, on your auto loans, and on your student loans. And as a result of those interest rate increases, interest payment now as a portion of consumer income is the highest that we've seen since the global financial crisis. So consumers are starting to have to pay more. It's taking up a greater portion of their wallet. They're eating into their savings. Something's got to give. Another transmission mechanism for the Fed is you hike rates and it depresses the economy, and that's normally felt through real estate. We're starting to see that too. I'm sure a lot of you would have read headlines around commercial real estate in the US and in Germany, where there's a lot of pain being currently felt. Office prices are down around about 13% year on year in Germany. That's the biggest decline we've seen on record. And office prices are starting to decline quite materially in the US as well. There are a number of blocks that have traded hands in the last year or so at 25 to 50% below their previous price. And that's a problem because commercial real estate is collateral for loans. And so when you land up with commercial real estate going down, you typically land up with knock-on consequences for the financial sector. And we're only just starting to see that now. Default rates are still below 2%. That's on the chart on the left. You can see it's still very low by historical standards. So we're getting to the part of the cycle which is quite lumpy, lots of uncertainty. What does that mean for South Africa? Well, as a starting point, the dollar is very strong at this point. This chart shows the inflation-adjusted trade-weighted dollar. So it's relative to all of its trading peers. Up means strength, down means weakness. The dollar, as we speak, is close to the strongest that it's been in the last 30 years or so. There are only 3 occasions it's been stronger in the last 50 years. So you'd have to be quite brave to say that the dollar is going to strengthen over the next 2 to 3 years, off record strength. But we also know that when there's a slowdown, the dollar tends to remain strong. So basically what we expect is while all this uncertainty plays out, up until the end of the year, call it, the dollar remains strong. But post that, the next 3-5 years, we expect a period that's likely to be characterized by fairly persistent dollar weakness. And that presents an opportunity. It allows the rand to strengthen for no reason other than the dollar weakening. It's got nothing to do with us. Another important economy to look at is China. We look at a range of leading indicators for China. There's total social finance, which is basically money raised through IPOs and debt issuance. That's up 17% year on year. So companies are gearing up to spend. If you look at tourism, the number of Chinese tourists on train trips for this Chinese New Year, it's up 60% year on year. The number of tourists in Shanghai, that's up 50% year on year. These are big numbers. The Chinese economy internally is rebounding, and we would expect that that's going to provide continued support for commodity prices too. So that's an opportunity for SA as well. The next slide, this slide over here, if I manage to convince 10% of the people in this room that it's true, I think it'll be a victory. We track the performance of the South African SOEs. We've created an SOE index. It's an aggregation of the performance of Eskom, our rail network, and our port network. And we put it together because we spent some time debating whether South Africa is in structural or cyclical decline, and we needed a hard measure to be able to define that. So for some time, we've been tracking the SOE performance, and you can see it hasn't been a pretty picture. I think anybody in this, or everyone in this room, would be aware of a trend decline. But believe it or not, over the last year, there's been an improvement. Come up off the bottom. And we can see that through the Eskom energy availability factor, which is now roughly in line with where it was last year. It stopped deteriorating. We can see it through rail performance. Believe it or not, the headlines are always negative. Rail performance has actually started to improve, and the number of containers handled at our ports is up year on year. So we put that all together in an index, and this has actually started to improve. Now, we know SOEs have been a massive problem for our market. It's affected the currency, it's affected the local equity market, and it started to turn. And we don't see any attention placed on this. Yeah, my final slide, and I've already stolen some of Barry's time, is on what does all of this mean for local markets. Now, we can say what it means directly. We can say US markets are going to be weak, and therefore the local equity market's going to be weak. China's rebounding, so it's good for commodities. SOEs are turning, good for the currency. But there's a more fundamental point. The chart on the left shows the percentage of local stocks in the SWIX that have had a return more than 20% away from the benchmark over a 6-month window. And there's 3 periods that are of significance. 2008, and for those on that side, that's a bit over there, where we had 80% of the local market returning more than 20% from the benchmark. 2016, where we had about 50%, and 2020, where it was around about 60% or so. Those are opportunities. Those are periods in the market where you have massive dispersion locally. And the common theme through each of them is low equity returns. So before I hand over to Barry, the key point, or the part I want to say now, is we are entering into a volatile world. A volatile world means low returns. But low returns also means greater dispersion. And we would see that as opportunity. It provides the best chance for us to deliver meaningful outperformance relative to a benchmark, which is often quite difficult to beat. And on that note, Barry, I'm going to hand over to you.
Thanks very much, Chris. Always a tough act to follow. Starting off with the stock pickers market, yes, it is a tough market, but I also like to remind myself when sentiment is low and valuations are low, that's when we actually should be getting excited. If you have a look at the year-end review, a lot of the performance came from the financials, specifically from the banking sector. What detracted over the past year was the platinums. We had overstocking in rhodium and palladium. But who knows what will happen this year? As you can see from this slide, there was already almost like a bifurcation in the market last year, and we expect that to continue. If you had to, my expectation is over the coming year, earnings are still going to disappoint, but people are looking beyond that. Well, we're certainly starting to looking beyond this 1 year of earnings. We're at a point where we've peaked in interest rate cycle. We've done a little bit of work in terms of what sector works best once interest rates start declining. So as you can see on the top left, you can see our JSE resources close to record low valuations alongside our general retailers index. So work we did is we looked at once interest rates started falling, what gave you the best leverage to that outcome. And from your discretionary retailers, you get 36% on average from that significant outperformance over your more defensive retailers. So for us, while we're getting excited about the longer term, in the shorter term, I think we're looking for companies where there's a self-help story, number one, or number two, they're quality companies that can still grow, or they've got a specific growth opportunity in the short term, like a Roynet. So what we decided to do was just put together 3 of our ideas to demonstrate some of our stock picking thoughts. We started with a low, a medium, and a high risk. For our low risk, we've chosen Anheuser-Busch. That's a company that fits in both our equity mandate and the dynamic equity mandate. It's got 7 of the top 10 global beer brands. The input costs are starting to roll over, so there's a lot of margin expansion opportunity. It's probably best placed that it's been since the SAB Miller deal. And we also mercifully recognize that the impact of that boycott is starting to roll off. So one of the more prime backers of the boycott, Kid Rock, has recently been publicly drinking Bud Light again. And actually Donald Trump has actually come out and said Bud Light deserves a second chance. They've also managed to reduce their debt, which is an ongoing effort, and they've started a significant share buyback. And with that reduction in their debt to EBITDA ratio, they come onto a lot more investors' screens. So trading on about a 17 forward now, be well below its long-year, 10-year mean, and probably in the best shape it's been in a long term. So defensive, some self-help, coming off a low base with that campaign last year, and also that margin expansion opportunity. On the medium risk side, you heard me speaking earlier a little bit about the discretionary retail space. SA probably only pure play retailer is Mr. Price. They're coming off a very weak base last year. Part of it was because of Shane, which has, or Sheen, I always get that wrong, sorry. Well, I may be wrong on both counts, but effectively that's changed. The import duties, I think, for Sheen have gone from 13 to 34%, so they're less competitive than what they were. Mr. Price has gone on a rollout of ensuring that they are well prepared for load shedding. So that impacted their stock turn. They took a lot of stock write-downs last year. And we actually expect them to show the best sales growth in the SA retail sector this year. So if they can return to their 2018 EBIT margins, there could be 70% upside to their earnings from here. And you can see that discount to their 10-year average over there, so significantly cheaper than what it used to be over the long term. But not to say that it's necessarily going to go back there, but we certainly see a chance of it regaining a lot of that. And then on our high risk, and just to reiterate, this is not for widows and orphans. We were observing Nampak for quite a while. What got us quite excited was A2's involvement, so we put our hand up to get involved with them. We subscribed to and we helped reduce the rights issue, we helped improve the remuneration policy, and we've also been quite involved with just getting the business on the right track. So a lot still needs to be executed there, with particularly the Nigerian sale. But once that's done, their balance sheet will be in a lot better position. And our base case scenario, I mean, we shouldn't put forecasts like this in, but I mean, I'm not even going to repeat it actually, but there's pretty good upside if everything goes according to plan. But, you know, nothing ever does go according to plan, but there's a bit of fat in there, and it's one we're quite excited about it. We've right-sized it correctly. It's in the sort of more stock-picking portfolio, dynamic equity, but one we're quite excited about. It's probably only your like listed private equity play that you can get. So, and I think what's most important for us here are the people involved. A2, and in particular Phil Roo, who's come in, who's a trusted pair of hands and has done this in the past. Then just ending off with performance, we've got 2 funds in the SA equity space. We've got our Investec BCI Equity Fund, which has been outperforming its peer group and its benchmark over all periods from what I can see. And really the difference between our 2 funds, the BCI Equity and the BCI Dynamic Equity does have the option of investing offshore. So if you're looking for a fund that has SA equity plus some offshore, that's your equity fund. That's got more of a growth at a reasonable price philosophy. And then our BCI Dynamic Equity Fund which is more of a stock picking mandate. It's a pure SA building block. We recommend it as a satellite portion of your SA equity, not necessarily was your whole SA equity, but that has delivered serious alpha over the long term and has won us numerous awards. And with that, I think I'm almost on time. Thank you very much.
On time. Any questions for the Investec team? Right, too early in the morning, can't be. Maybe just quickly on the two funds, the equity, dynamic equity, can you unpack a little bit more the subtle differences between the funds? Similar benchmarks, same category. How do we pick either or do we pick both?
I think both is what we'd recommend.
Right.
Probably what we what we normally do for recommend is either like a 60-40 or 70-30 split between the core equity fund, the equity fund, and the dynamic equity fund. So the dynamic equity fund is not going to work in every environment. It is a stock picking mandate, but it is pure SA focused. So when offshore is doing well and when the rand does blow out, dynamic equity is going to struggle. The equity fund, like I said, is more quality focused, more growth at a reasonable price. But it does have that offshore exposure. It leverages off of our global mandates, global leaders, and our global sustainable equity. So it does have that good stock picking in the offshore market capability. So depending on what you want, like I said, they're both in that equity space, but they often perform very differently to one another.
You mentioned the Global Leaders Fund. We didn't cover it here today, but also a very good fund to look at if you're looking for global quality. But we're all going to park it there. Maybe next time we can unpack that a little bit more. Chris and Barry, thank you so much for coming through this morning. Really appreciate it. Thank you so much.
Pleasure.
We've heard it right through the year so far, and in the last year as well. SA equity still cheap on any kind of metrics that you look at SA equity. And some say there might be potential for higher returns in 2024. Who knows? Coming to the stage now to talk exactly about SA equity. Formidable panel for you. And gentlemen, you can come to the front so long. Charles Gous from Butterleer Asset Management. Roger Williams from Centaur Asset Management. And Zandile Kunyana from 361 Asset Management. Charles, you're up first. Yeah. Thank you so much for being here. I'm going to step off. Charles, you can step up. You first. And we actually in order as you are sitting. Thank you so much.
Good morning, everyone. I'm Charles Gous from Butterleer Capital. I'm here to tell you a bit more about our business and in particular the Butterleer BCI SA Equity Fund. Let's start off with where we come from. So Butterleer was founded as a hedge fund management in 2004. Our longest running products are now approaching a 20-year track record. Given our hedge fund background, we've got a clear focus on capital preservation equity funds, where we apply a consistent investment process across the funds that we manage. We don't like to be constrained to any specific investment style, so we remain flexible in the way that we research and buy equities. I think also importantly, the business is 100% owner managed, with all key individuals in the business being shareholders and active in the daily running of the operations. We're not a particularly large asset manager by AUM, so our smaller size affords us the opportunity to access the broad market on the JSE, as I'll show you a bit later. Just go on here. The BCI SA Equity Fund has outperformed its benchmark over the long term. Our longest running long-only mandate is now also approaching a 13-year track record that's annualized 2% in excess of the benchmark net of fees. In addition, the funds performed well over the medium term on both a relative and an absolute performance, as you can see on the charts on the left-hand side. I think it's also important to take a step back and just look at the performance of the fund on a 3-year basis to the end of December 23 relative to, for example, the MSCI World Index. So what we've done here, we've converted the MSCI World Index returns back to rands. That's compounded at 16% a year versus 16.8% for the BCI SA Equity Fund. I think that's important to highlight because the question we as a SA equity manager receive consistently is how are we going to generate returns in a low growth environment. Hopefully this presentation we can give you a couple of examples of where we think we can do that. Let's start with our domestic economic outlook. So I prepared several slides. Lucky for you and for me, I deleted all of them, and especially after the presentations we've just had. And I opted for one quote from Udaco CEO Graham Dunford at a recent results presentation. We expect much of the same up to the elections, and then much of the same. I think it's fair to say from a macro point of view, our expectations are extremely low for the SA economy. Don't think we can get up here and talk a very bullish scenario from a top-down point of view. But then why do we get up here? Why do we talk about SA equities? It's really the bottom-up equity selection process that gets us excited about the companies that we can invest in, the opportunities we see, and specifically the quality of the companies that we can identify. I'm going to quickly take you through our investment process. I'm not going to go through all the detail, but essentially we ask ourselves 4 questions. Does this business have the ability to generate above average returns over the long time? Why does it have this ability? Who are the stakeholders involved in the business and what risks can we identify? And then lastly, we look at valuation. So our process favors a higher quality sort of outcome in the companies that we select. Now, usually when you do this kind of analysis, you trip up on the valuation side because good companies are generally more expensive or too expensive to invest in. As we look at the market at this stage from a domestic point of view, from a bottom-up view, we see very high-quality businesses trading at very reasonable valuations, companies that continue to perform well. I've sort of put down a couple of examples, and I split it up into companies that can gain market share, companies that's done very well to internationalize their business. Cash is king. There's some very highly cash-generative businesses that provide good shareholder returns, and some stock-specific opportunities that I will go through today. So let's start with the first one. In our previous outing at a BCI conference, we gave a detailed analysis of our views of Shoprite versus Pick n Pay. So I'm not going to repeat all of that today. Fair to say that things have gone worst for Pick n Pay. They just recently announced the rights issue, and they also have to sell down some of their Boxer stake to try and repair their balance sheet. Over the last 5 years, Shoprite's market share has grown from 23% to 36%, clearly indicating their superior execution and how they can grow in a low-growth environment. That's the point of the slide. There's always market share to be gained and competitors to be outperformed in the market. Our next example is a company that's done phenomenally well to internationalize their business. Bidcorp has got its roots in South Africa, but ultimately it was spun out of Bidvest in 2016. Bidvest moved into food services 34 years ago with 2 small acquisitions. From there, Bidcorp has become a globally diversified business that trades in 35 countries. They've got strong positions in the likes of Australia, the UK, many European countries, and emerging markets like South Africa and China. It's also got an impressive track record, growing earnings at 14.9% over the last 10 years. This is the quality of the businesses that can still be acquired on the JSE. If we look at the chart on the right-hand side, it's interesting to see how Bidvest is following a similar playbook with the international services business. This business used to contribute 12% of their trading profit. Currently, it's 25%. We expect that contribution to grow in the years ahead via organic or inorganic growth for Bidvest, and that they will follow a similar playbook and unbundle the services business once it reaches scale to create, in essence, another Bidcorp. Again, these slides serve to provide an example of how companies can move out of the country and do well, and new business opportunities can be created for us to invest in. Cash is king. AVI is a fantastic FMCG business with branded goods. Some of the household names that you'll know is Rooibos Tea, Alice Brown Coffee Creamer, Baker's Biscuits, to name a few. What makes this company special is its ability to return cash to shareholders. It's done so while still reinvesting in its business for growth. Since 2005, this business has paid 95% of its headline earnings back to you as dividends and special dividends, while still growing earnings and still maintaining a dominant position in the categories that they serve. Just in the last 10 years, you would have received back 53% of the current market cap, not the market cap at which you acquired it. So great shareholder returns that we can see continue into the future. It's a highly cash-generative business that's got a fantastic industry position. To Barry's point, AB InBev or Anheuser-Busch, this is an interesting example for us on the market. It's a business that faced headwinds that's currently turning to tailwinds. So AB InBev's acquisition of SAB Miller in 2016 introduced additional debt to the balance sheet. At that stage, the business was highly geared. Our process don't necessarily favor businesses that's got a lot of gearing, and we avoided investment in AB InBev. However, it's a highly cash-generative business, and they managed to repay $43 billion of their debt since 2016. That risk is now reversed as the balance sheet has largely been repaired. So the tailwind is, as the balance sheet is repaired, we expect dividends to actually grow faster than earnings in the medium term. Additional tailwinds is from their cost of goods, which saw significant inflation post-COVID and margin compression. The chart on the right shows you how that has declined and is actually becoming favorable for them in the short term. So again, we expect margin expansion, dividends growing faster than earnings from a highly cash-generative business. There's also some very stock-specific opportunities. AECI has got the opportunity to refocus their business. Within AECI, the crown jewel is their growing global explosive business that contributes more than 50% of the group's earnings. At a recent strategic update, the new management team put out some punchy targets for 2016. In fact, they expect to double earnings by 2016. This is not that difficult to achieve because there's some loss-making areas in the business that's up for sale or closure that will greatly assist them to get to that number. In our opinion, those lofty targets are not in the current share price, and should management get to somewhere close to those, there's significant capital gains to be had for shareholders. Remgro is another interesting option on the market. It's currently traded at a 37% discount to NAV, and you can see the discount history there all the way back to 2002 on the screen. It means for every 63 cents you spend buying Remgro shares, you get 100 cents in NAV. Now, Remgro management has got the opportunity here to change their capital allocation priorities. There's cash and listed equities that they can sell or distribute to unlock shareholder value through share buybacks and to unlock the discount. So there's a material opportunity there for shareholders' value to be created. Another example is some stock-specific opportunities, especially in the mid-cap space. Within the mid-cap space, there's some very well-managed, high-quality companies that's under-owned, under-researched, and unloved at the moment. They have performed very well over the last couple of years. You can see in the blue bars, Udayco produced record earnings in 2023. So has Adcock. However, in the red bars, their valuation multiples has continued to detract or derate. We think there's great opportunity in this space for corporate action as companies are taken private either through industry players or management buyouts. That leaves me to sort of the last point I want to make. Can your manager access these opportunities? In the table on the left, we split up the JSE Cap Swix and how the main drivers of this index play out. Rand Edge and dual-listed companies, precious metal miners, and companies exposed to China and resources make up more than 50% of the index. They're exposed to three very difficult to predict drivers, i.e. the Rand, precious metal prices, and China's economic fortunes. We want to draw your attention to the bottom of that table, the SA Inc. portion. That's especially where we're finding very good opportunities. I've listed a couple of household names there on the right-hand side, and they're weighting in the index. We've also run an exercise to say, what if a 10 billion rand fund wants to acquire 3% holding in one of those names, assuming they trade 10% of the market per day? You can see the number of days to trade that is required for them to acquire a position. So it's very difficult for a large fund to participate in that space, especially lower down on the list, and gain a significant shareholding in some of these companies where we see great opportunities. So in closing, the Bateleur BCI SA Equity Fund has a lengthy track record of outperformance. We've got deep knowledge about the SA opportunity set. We've been doing it for close to 20 years. We're nimble and flexible, so we can move quickly and change positioning. Another advantage of our size, that we can build up differentiated positions relative to the index, as I've showed you earlier. We generally run a high conviction portfolio and we're comfortable with less than 30 positions. And we remain encouraged about the opportunity set that's available. And I hope I demonstrated some of those opportunities today. Thank you very much.
Good morning, everyone. My name is Zandile. I'm part of the investment team at 361 Asset Management. Thank you all for coming out this morning. Really appreciate it. And quite excited to discuss some of our views on the market and our current positioning in what should be quite an interesting year. But before we get into that, just a brief background about who we are as 361. I'm sure many of you are quite familiar with the firm, but for those who aren't, we've been around for about 20 years. We're a boutique, still quite small, AUM around 45 billion rand, and we're still owner-managed with a team that has had very low to almost no turnover. The reason why I really wanted to point that out is because when you look at our performance, that track record has been built by the same team that is managing our funds today. So we really do own our track record as a team. And as you can see, our performance has been quite consistent over that time period. Our firm initially started out in hedge funds, but since then, we've really branched out to offer a more diverse range of products, and our SA Equity Fund now has about a 10-year track record, almost, in a couple of months. In addition to that consistent performance, what I also wanted to highlight is how we've been able to deliver that with less volatility than the market. So if you'll bear with me, we are a bit obsessed with performance. So looking at it in a slightly different way, we see the long-term alpha generation that our fund has been able to deliver for our clients. And even in a year like last year, where we maybe got caught a bit offsides with the Q4 rally and underperformed, we've been able to catch that up year to date. So that graph is up to the end of January. We're almost at the end of February, and my compliance isn't here, but I can confirm that we are pretty much still on track with that continued outperformance year to date. But more importantly, looking at these different time periods, our team has really been through different cycles and experienced different stages of the market. And throughout that, in addition to delivering consistent alpha, what we really focus on, and it's due to that hedge fund background, is making sure that we always protect capital in downturns. The way we've shown it on the slides is with an example in 2020, where our funds were able to significantly outperform the market, not necessarily because we bought everything at the bottom, but because we made sure that we were in maximum cash at the right time and protected our clients' funds. And we've also shown our information ratio, which we think is quite important, especially when talking about an SA equity fund. We are benchmark cognizant, but we are active managers. And a market like this with so much volatility is a stock picker's market, so that really does excite us. So I didn't have Charles' foresight in deleting all of my macro slides. I hope you'll bear with me, but I'll make sure that I focus on our positioning as I go through all of this. When we look at SA, I'm not going to stand up here and paint a pretty picture. The outlook is still challenging. But what we think is that things are improving on the margin. What that means is they've gotten so bad that we think that incremental change is actually making an impact. That's at the earnings level, but also at a multiple level. So looking at the four big themes that our portfolio is reflecting, going into this year, obviously everyone is looking forward to rate cuts, probably happening in the second half of the year. But what we think is really important, especially from a growth perspective at a macro level, is SOE reform. Chris already touched on it, and the fact that things are improving at Transnet and definitely at Eskom. We're seeing fewer unplanned breakdowns, and the new management team at Transnet is already receiving very positive feedback from many of the CEOs who we've been meeting, especially going through this results season. Now, of course, geopolitics and elections, it is a big election year. Eugene said the market is always, having these events and it's always uncertain. But what we think is quite different about this year is how many potential outcomes there are. And for us as managers, that makes it a bit difficult to start assigning probabilities to this. So that's why we think that this will be a year of elevated volatility. So that negative isn't necessarily to say that elections are bad, but rather that it is going to cause some bumps along this year. And for us sitting in SA, China's recovery is always important for resources and for the biggest name on the stock exchange. So we're always monitoring that, and I'll give you my views on that a bit later. So just briefly to touch on inflation, this is pretty much the consensus view right now. The easy part of inflation has really been solved. We've seen, energy prices coming down, US wage growth is still quite elevated, but we're not seeing the rapid expansion that we may have seen last year or the year before that. And so our team is quite confident that given the current restrictive policy by the Fed and even locally, you're still likely to see rate cuts coming. Even though we've seen inflation spiking again, the stickier parts related to services, the US is a bit of a different animal, so we're going to park that for a bit. When you look at Europe, economies that are a lot more sensitive to a very restrictive monetary policy, they are responding and economies are slowing down. All of that supporting rate cuts. And with the US, their inflation includes idiosyncratic factors like shelter inflation, which isn't a very objective measure. It's essentially going around to people and saying, how much rent would you charge? And so things like that are quite difficult to come out of the system. But we don't think that that would stop the Fed from continuing with cuts later on this year. So the real challenge that we're facing until those cuts come is growth. Growth is slowing down in all of major developed markets, and specifically at our export partners. And unfortunately, that does create a very muted commodity demand environment. And so in our funds, we've been quite underweight resources. It's a view that we've been expressing for a couple of months now, and it's turned out to be the right call. Lately, we have been changing this tune and starting to add more resources exposure, but right now, we do prefer commodities that have more supply discipline, because we don't think that the real delta is going to come from more demand anytime soon, but instead it's going to come from those sectors that can actually restrict the supply side. So now touching on China, we've been quite cautious on the recovery in China, and that has been the right call that we've made over the last year or so. That's definitely influenced our resource exposure. The reality is that the economy is facing a number of different challenges, and the graph on the right-hand side there is showing the current savings rates in China. As you can see, it's quite elevated compared to other economies such as the EU, US, and Japan. And what that shows us is that you have very low consumer confidence. And without consumers wanting to spend, businesses wanting to spend, the growth recovery is likely to still be quite muted going forward, which impacts our resources. So when we think of our general China exposure in our funds, we are still preferring to express that through a NASPAS process, and I'll go through a bit more detail later. Another theme which we haven't really discussed yet this morning that our team has really been focused on is rest of Africa and the FX risk that's inherent in a lot of companies listed on the JSE. Going into this year, we had quite significant underweights in the telcos, mostly because of MTN's exposure to Nigeria, the Naira. We've seen extreme volatility in those markets. And maybe a bit similar to what I said about SA in the beginning, where things are challenging but improving on the margin, we have seen some improvements in these exchange rates. But the reality is, when we're sitting in a very volatile year where dollar strengthening is highly likely, a lot of these currencies will likely remain under pressure. So we are still quite cautious on companies in our portfolio, or rather companies in our universe that have a lot of FX risk exposure, and that has proven to be the right call so far. And then the election. This is a topic I'm sure many of us have been debating, and our view on our base case likely outcome when it comes to the election is based on the polls that we've been seeing. And right now, our portfolio reflects the base case view that you're likely to get more of the same, similar to what the Hudayco CEO said. you are likely to get, potentially below 50% for the ANC. And we are probably going to go into a coalition with some smaller parties. From our research, it's likely to be a party like the IFP. And even though this is our base case, we're making sure that our portfolio is still bulletproof if there is an outcome that doesn't align with that. And I'll go into more detail in that a bit later when I talk about our positioning and how we manage these kinds of risks. Okay, so, looking at all of this in the SA market, like I said, a lot of these challenges are prevalent and they're unlikely to go away. But what we do think is going to be the case in a year like this is that with SOE reform, with rate cuts, you are likely to see some value in the JSE actually being realized. Because the debate is always, is the JSE just a value trap, or can you start to realize the value of your investments? And when we look at the relative value compared to other emerging markets over time, we are trading at a significant discount, which in our view does reflect a lot of these idiosyncratic challenges that we're experiencing in SA. And the reality is in a year like this, where there is so much volatility, things change very quickly. And so how do we as managers then prepare for that potential for things to change? Well, that takes us straight into our positioning. At 361, we're very proud of how our funds are able to be nimble and flexible. Our size is a very big advantage in this kind of market. We've seen liquidity, significantly decline on the JSE. And what that means is that it's very difficult to make a massive investment decision in one day. Our funds are at an advantage because of not just our size, but also the way that we are decisive and actively manage our portfolios. What we've shown on this slide is an example of how when the facts change, we change our minds, and we do so decisively. So the example we've shown is in April 2020, 2021, and January 24, 3 different time periods. April 20 is obviously reflecting lockdowns, very different conditions there, and I'll use banks as an example. We were able to make sure we cut our exposure very quickly at the right time and held an underweight to banks. April 21, just a year later, understanding the fundamentals, but also taking into account the macro conditions, we understood the value that was there in our SA banks and reflected that in our overweight position. And as we sit now in January 24, because it is a stock pickers market, overall, it looks like we're pretty much on weight with banks, but one of our largest underweights is actually one of the local banks. And so right now, what we're seeing is not just opportunities across different sectors, but really within those sectors. And as stock pickers, that makes us really excited. So what is that positioning? Well, as you can see, we are really favoring Naspers and Prosus, mostly because of improvements at 10 Cent. Absa is the bank that I was referring to earlier, which we think is trading at a very reasonable valuation. Our banks have been very disciplined with the way that they've managed credit risk, and we think that it still reflects good value in this market. And the third overweight that we have is Grindrod, one of those mid-cap stocks, which once again reflects our size, ability to actually invest in something that's small, that has really taken advantage of expansion in the rest of Africa. Some of the deficiencies in our ports are now benefiting Maputo, and Grindrod has direct exposure to that. They actually released a trading statement this morning with exceptional growth of 20% earnings growth, and we're quite happy with that business, the management team, and the way that they've been able to navigate the current environment. So I mentioned that banks in our example were pretty much on weight at a sector level. So when you see it our underweight, it's reflected in Standard Bank and Capitec. Capitec, a bank that we think is quite expensive relative to its growth, and Standard Bank, a bank that did very well for us last year, but we just cut down our exposure there, given its valuation relative to its history. And so looking at our positioning in a different kind of perspective, our Rand hedge is about half our portfolio, and then SA Inc. the other half. This shows our view at the end of January. We have been shifting our mindset slightly and growing our SA Inc. portfolio exposure rather since then. And the way that we've been doing that is really opportunistically. We think right now, because of the high level of uncertainty in the market, you've actually seen a lot of investors crowding in Rand hedges as a safe space, and that's left very attractive opportunities in SA Inc. And so we've been increasing our exposure to high-quality companies that have strong balance sheets and that we think are able to better navigate this volatile environment. And so in the last few minutes, just to briefly touch on one of the stocks that we really like right now. I've mentioned this Rand hedge and how we're switching a bit more into SA Inc. But the reason that we've still maintained our Naspers process overweight is we think that there are a lot of fundamental reasons that support a re-rating of the name over this year. Firstly, Tencent itself is not relying on top-line growth to really deliver that mid-teens EPS growth that we're expecting this year. One of our analysts was in China last year, met with a number of CEOs, and what's very clear is that a lot of those management teams, similar to US tech teams, are thinking more about efficiency. We've seen their gross margins expand significantly, and that's what's trickling down to that EPS number, and those are the type of companies that you want to be exposed to in an environment like this. So that's the way that we're preferring to play our China exposure, and we're maintaining that overweight. Then at a Naspers level, we are seeing the buybacks continuing. We're quite happy with the management team change, but also the mindset shift when it comes to capital allocation. A much improved framework that is actually putting shareholders first. And those are the type of opportunities that we're always looking for on the JSE. Management teams that are focused on returning cash to shareholders and looking for the best ways to create value with us in mind. And then lastly, another aspect of the stable that has really changed is the free cash flow positive nature. We are no longer seeing money kind of being thrown at these European tech companies, and instead management has refocused a lot more on taking their dividends from an investment like Tencent and using it in better capital allocation verticals like buying back shares instead of investing that cash in companies that don't provide a return. And so, what I really want to leave with you today is that at 361, we do believe that the outlook for this year is obviously quite challenged, but we still think that there are opportunities because things are improving on the margin from a macro level, but also at bottom-up level. So we've identified these companies that we think have good management teams and very specific catalysts to realize value over this year. So the market overall may be a value trap, but we've really focused on finding those right opportunities to make sure that we can continue to deliver that consistent outperformance. Thank you.
Good morning, ladies and gentlemen. I'm the CEO of Centaur Asset Management. Just a bit of background about Centaur. Founded in 2000 with three core principles, very important. One, to deliver investment excellence, and as any of you who know, I think we've delivered on that with outstanding service and utmost integrity, which goes without saying. We focus only on retail assets. We don't have institutional assets. We've purposefully kept our pool of money smaller. So at the end of January, we had 8.2 billion of assets, and that really allows us to be more nimble. We also have a balanced fund, and we have also offshore investments within our flexible and balanced funds. So our pool in South Africa is relatively small, but we've got very strong pedigree in South African equities. We launched a South African equity fund last year on the 30th of November, and I'll talk a little bit about it. Just looking at our flexible fund, which has been operating almost 20 years. At the end of the year, it's going to be 20 years. Since inception, we've done 16% per annum. That's after fees. Over 10 years, about 11%. That's number one in its category. And 5 years, 13%, also number one in its category. So over successive periods, very strong returns and very strong rankings in its class. Just looking at our investment philosophy, what we're looking to do is buy a growing company which is undervalued. And I think it's very important that we find during our time horizon, which is generally 3 years, that the company grows. So it may not be a secular growth area. It may just be reasons. Maybe there's a change in the interest rate cycle, change in commodity prices. But over that 3 years, it needs to grow value. And if we can find an opportunity that is both growing and undervalued, you get arbitrage returns as the value moves to fair value. So if you can see on that diagram, if you buy something 25% below fair value, it moves to fair value over 3 years, and the growth is 14%, you leverage up your 14% to 25% returns. So this is what the investment team are looking for. We're looking for opportunities that can deliver on this. And we've developed this philosophy into processes. So first of all, we've got equity analysis templates. We've also got macro models to guide asset allocation. But most importantly, we've put all our information into our portfolio management engine, which really tallies up all the information and allows us to manage our portfolios with a lot of control, particularly during times of volatility, and it's come out with exceptional results. So our top six stock picking engine's been largely unchanged for 20 years and has proven itself through the years. Just looking at South African outlook, I think we're coming off an exceptionally low base, but I think slightly positive signs are emerging. So as was earlier discussed, Eskom, the load shedding is reducing. Transnet, they are working hard to get on top of it. I think it's a multi-year project, all of these things. But off a low base, things are improving. Fixed investment is also improving dramatically. So for example, Wilson Bailey Homes has a record order book, and generally GDFI and construction has picked up dramatically, which is good. We need infrastructural and fixed investment to grow. And we think future economic growth should be better than the past, okay, off a low base. And we're also finding some good ideas in South Africa. Just looking at GDP growth, you can see how dismal it has been over the last 10 years. So we're looking at successive 5-year periods. So at the end of 2018, the average growth over 5 years was 1.2%. Over the last 5 years to the end of 2023, growth has averaged 0.4%. And we've had strong load shedding, we've had the COVID, we've had Transnet, and I think it's actually surprising that South Africa has actually done so well with all these challenges. So South Africa is a very robust country, and still managing to grow despite those challenges. Looking ahead, we are looking for slightly better growth, maybe in the band of 1 to 2%. Still not good enough, but an improvement, albeit off a low base. We think South African equities have the potential for high returns. The reason why valuations are good, as many of the earlier speakers, there's some quality companies very well managed, despite a difficult environment. And you can see the P on a P ratio over the last 15 years, we're trading at about a 17% discount. On average, we're on around single-digit Ps on forward P ratios, which is exceptionally good. We're finding many companies with dividend yields of 6-7% plus. I think when I started 30 years ago, anything on a dividend yield over 3 was high. So the dividend yields are exceptionally high, which is reflecting the low growth. And if the future outcome is better than expectations, we could have a very good outcome for SA equities. Also, something which makes us positive, we see the peaking of the interest rate cycle. What we found is interest rates in South Africa follow the US. Really, the Reserve Bank has to keep our rand relatively stable, and they use interest rates to do that. But if we look at the 12 by 15 forward rates versus the current rate, the market is signaling they expect interest rate cuts. So that's really the red bar on the bottom graph, expecting interest rate cuts. I'm not sure the timing. It seems to be possibly being pushed out a bit further to the second half of the year. But it's highly likely we're at the peak of the interest rate cycle, and the next move will be down. So this is really necessitating a slight change in our investment strategy, maybe more in the flexible fund where we do have discretion. So we're increasing SA equity exposure. We're doing this selectively, so we're looking for dips, buy judiciously where we see exceptionally good returns. And what we found, this has been proven, is if you look over the last 30 years, when interest rates drop 1.5% off the peak, it really turbocharges South African equity returns. So during tight interest rates, the JSE All Share Index has only returned 1% per annum, so underperforming cash radically. During the loose phase, when interest rates drop 1.5%, the compound annual growth in JSE equities have been 24%. So very, very strong growth during the loose phase. And this is really guiding us because we are entering into the looser phase, so slight change in asset allocation. We think these models, you have to be careful because things change, so we're going to be more preemptive in increasing South African equity content as we see opportunities now going into the election. Great time to go overweight. Some of the select South African opportunities, we see a mix here. We don't have any real theme. So PPC, the largest cement producer, a new CEO has come in. He's looking to cut costs, improve profitability. They also sold one of their Rwanda operations, so very cash flush. We expect a special dividend. If we put all these things together, we think returns of 25% plus are quite positive, are quite possible. And you can see very depressed PE ratios for the biggest cement producer in South Africa. Aspen, we like what management's done. They reduced debt over the last couple of years. They've set a foundation for global growth. We think they're starting to put load on their global foundation, and the growth is going to come through. It has already performed quite well, but we see returns of 15% plus, which are possible from Aspen. Process, it's already been covered in the previous presentation, but really our view is almost identical. Management are focusing on value creation. Tencent are focusing on profitability, value creation, share buybacks, and still at a very reasonable multiple. So we have been buying Process quite aggressively in our funds. MMI Holdings, that's a bit of a special situation. It's an insurance company trading at a 43% discount. What's exciting there is they've got an Indian healthcare joint venture which is growing very fast. We do anticipate that they'll probably listed in the next 3 years, and that's going to be a catalyst to unlock some value. We think returns of 20% plus are quite achievable there. You are getting yields of about 7% from MMI Holdings. Pick n Pay, we're kind of just nibbling here. I think it's still early. We're watching. I think there is risks, but there's also upside. Management really have to salvage value from the core Pick n Pay and the franchise businesses, whilst Boxer is actually doing exceptionally well. So if they get it right, we think there's multiple upside in this one. But having said that, in the equity fund, we don't have a position in it as yet. Just looking at the SA Equity Fund, which we launched at the end of November. This is only South African equities. We've got a very strong pedigree in South African equities, which I'll show you on the next slide. And currently, it's about 400 million of assets under management. If you look on the right, we're 85% exposed, so we've still got 15% cash. We're looking to tactically deploy capital into opportunities as they come, so we don't want to be rushed. The market has been relatively weak, so that's really playing to our hand. Looking at the biggest positions, ABSA, Aspen, which I've discussed, MMI, Process, and Richmond. We see this as an excellent pure South African building block if you want to focus on South Africa offshore as different components, fixed interest, a great building block of components. Just looking at asset allocation, this is from one of the stockbrokers, and you can see on the blue line, South African equity content is at record lows. It's about 40%, and offshore equity content is about 40%. So record low South African equity exposure. If things change, there could be a reversal of flows which could feed into our market. So there is latent potential for flows into South Africa. Just looking at the performance of our SA equity carve-out, so just giving you some idea how we've performed. So we've taken the South African equity returns within the flexible fund and see how we've done. And you can see over 5 years, we've done 14%, the benchmark about 8%. So relative to the index, about 6%. We are very nimble. We are able to gain trading gains. So that helps us. So despite a pretty difficult environment in South Africa, we've still managed to deliver good real returns. Just concluding, I think our process is proving itself. Our funds had an exceptional year last year. The team is working exceptionally. We've got great business momentum. The business is growing very rapidly. I think there's some positive signs emerging. We need interest rates to be the catalyst. I think the election has to be over. But we are increasing South African exposure, particularly in good opportunities on weakness. I think it's the right time to start upping exposure. And I think we are excited. We think a lot of opportunities which can give returns over 20% per annum, and we're investing in them accordingly. Thank you very much for your time.
Any questions from the audience? Yes, at the back. Do you need a mic? Yeah?
Just a common theme that's coming through is a big discount on valuation to historical averages and metrics. But wouldn't that potentially just reflect the fact that South Africa has become a systemically more risky environment? In which case you would expect a greater discount to, on a risk-adjusted basis. I mean, what role would that play as opposed to just saying the JSE is undervalued?
Any one of the speakers, can all of them go? Roger, you want to take that? Did you hear that question?
Well, I'm not sure if the risks are substantially more. I think they're kind of relatively stable. We know the risks. But I think it's really reflecting the zero growth environment. So as my slide said, the economy essentially hasn't grown in 5 years. And so it's reflecting almost in the models zero growth or even negative growth. So you're getting no real earnings, and so that's why the valuations are so low. But I think also, the fact South African investors can invest up to 45% offshores also reduce demand for South African equities. So I think it's those two components are the key aspects.
Charles, Andile, you want to add to that?
Yeah, I mean, one point I'd also add is, we manage SA equity funds, but I think all of us know that majority of earnings rather on the JSE isn't actually originated in SA. And so that's something that kind of gets lost a bit when we talk about companies' valuations and, general what's happening in the economy and the risk that we see there. So the way that we've been thinking about it is that those low valuations instead give you a very good entry point to companies that are still growing earnings. So it kind of goes back to what we were saying. When you look at the market overall, it may still be a value trap, but that doesn't mean that we're not finding good opportunities in select companies. And so, one of the best things about being an SA manager is that active management still works. And I think, so for us, that's not really a major concern when we look at the overall valuation.
Yeah, I don't have too much to add to that. I think your starting point is almost 12% bond yields now on the 10-year, so that's an 8 multiple. So I think that greatly impacts the current valuations. And I think the current valuations are largely reflective of the poor last 5-year performance. Roger also talked about the underinvestment in South Africa by not just domestic investors, but obviously we've seen a net sell of SA equities for pretty much the last 6-7 years from foreign investors, so it's very much under-owned, and that puts pressure on the share prices. I think what we try to put out in our presentation is that some of the better companies are also being impacted by these low valuations and the sort of flow of capital out of the country and out of the market. And that's where the good opportunities are, when you're really actually buying a 15 multiple business on an 8 or 10 multiple that's going to generate great shareholder returns in time. And you've got free optionality should anything improve domestically. We're not bargaining on that, but if it comes through, you've got optionality which you didn't pay for.
Thank you for that. Any other questions? Tian.
Perhaps everyone knows the process of being set in some way or form.
Yes.
Most people own Tencent and Pros at quite high levels because it's a big component of the index. And the one question that I think more people need to ask relates to the structural risks in China. okay, that relates to the regulatory scenario. So, I mean, I think everyone can agree that it's a great growing business and it's got all kinds of market share gains and there's very little competition in it. So it sounds all great until the Chinese government does things that, no one expects. And it's happened more than once in the last 10 years. So perhaps you guys can comment on how you compensate for that in the portfolios.
John?
Yeah, I'll have a go. With Saneli's colleague, I actually traveled to China in December as well. We met with James Mitchell in the first week of December. He's the chief investment or chief strategist at Tencent. Went through the whole prospects of the business from a bottom-up point of view. It looks fantastic. We touched down here on the 22nd of December. They get hit by a draft regulation from the Chinese regulator. So that risk is high. It's most definitely the scenario. I think from our point of view, what the Chinese government is facing at the moment is this low level of confidence, assets performing poorly, their equity markets are down, their house prices are down, confidence is low. So there was immediate pushback on that recent draft regulation that came through. By the Monday, we saw new games being released. We saw the regulator that put out the draft being fired. Subsequent to that, they released more games, and publicly the government came out and pretty much walked back that sort of process. So I think they've been through this tightening phase, and at some level, hopefully government there realized that you can only interfere so much with business because they've destroyed a lot of value, and you're actually at a very poor place now from an asset price point of view. So you cannot discount that risk. It will always be there. Just across the ocean, you've got Taiwan. That can be a problem in the future as well. So it's definitely a riskier environment to invest in from a regulatory point of view than, let's say, the US. But that's reflected in the valuations. So we have to keep that in mind. I don't think you get back to that 20, 25 multiples that we knew for China 5 years ago that easily.
Good stuff. Anybody else? Right. One last question. Let's do that.
Hi. This will just be a quick question. It's not for one of the specific presenters, but I just want to hear your views on Sasol at the moment. Is there any opportunity in it? Is the drop in share price justified at the moment?
Who wants to give it a go? Zanile.
I suppose I could.
Roger, you want to go
You
first?
can go, Roger.
Sasol's difficult because they're investing. Their free cash flow is very poor because they're investing so much in asset replacement. So they have to replace gas, green energy, reduce emissions. And it doesn't seem really management are that proactive. So they've been very reactive. Yesterday's numbers did not look good. Looking ahead, they do have some key attributes. So what really needs for it to perform is for the chemicals market to turn. It's been in a big depression. Europe's very marginal on an EBITDA level. The US is also struggling. So they need a turnaround in profitability. I would anticipate it happening. So that's more of a cyclical turnaround. But ideally, management can be more proactive in kind of reducing capex, improving shareholder returns, maybe cleaning up the portfolio. And we haven't seen that. So that's very disappointing at this stage. But there could be a cyclical rebound. But the outlook's not good at this stage, I don't think.
And sorry, just to add to that, that's what I was going to say. It's quite cheap when you're looking at PE, but right now the focus is free cash flow. So we do think that with the new CEO coming in, perhaps he will reevaluate the portfolio. They do have a couple of options, assets that could be sold down to support the balance sheet. So right now, similar to Roger, just think it's a bit too early. That CEO is likely to take his time a bit, but we think it's likely that things will improve, even when we look at government relations related to ESG pressure on the name. And we do just need the cycle to turn for chemicals. You've seen refining margins increasing, which should support them too in the short term. But the real big game changer will be rationalizing the portfolio a bit more.
On that note, I'm going to end this session. Charles Zandile, Roger, thank you so much for being here today. I think the takeaway from me is you've all shown the skill to manage SA equity. The evidence are there, but size does matter. Right. Thank you very much. Cool. Right. Next up, we're going to look at local bonds, and coming to the front at the moment is Nolan Wappenaar from Anchor Capital. Needs very little introduction. While Nolan is coming to the front, he's going to be first up. We did invite Brandon Quinn from Saffron as well. Unfortunately, he could not make it because of family commitments abroad. We did find it important, though, that we do get feedback from him. His views are always quite valid. So after Nolan presented, we're going to play a short recording from Anina and Brandon. I'm going to keep Nolan on the stage because he said he's willing to take all the questions that you have on anything. Nolan, thank you very much for being here, and the floor is yours.
Thank you very much. Do I get a machine? I need to drive here. So yes, very much. I get to fill the stage by myself. It's going to be an interesting experience, but here I am. Thank you for coming through to listen to us. I'm going to hop through it. No need to drag it on. So I'm going to talk about fixed income bonds, and I really want to start. I'm not going to go through introducing myself. I think it's been done. But I want to start by looking at what's happened over the last few years and South African bond yields. So this is a chart that Anchor publishes quite frequently. You'll probably find it on our website if you go digging. But it shows you bond yields over time versus what we think bond yields should be. I've then put two sort of pinkish dots that have moved slightly on the presentation screen in front of me. But basically, they are where bond yields are right now and where bond yields were 3 years ago. And the point I'm making is that over the last 3 years, bond yields have increased by 1.22%. A little bit of bond math, and what you're going to say is that if you bought a bond or the all bond index for a price of 100, over those 3 years, you now own the all bond index, and the price is about 90. You've seen the bond prices go backwards by about 10% over the last 3 years. And that's been sort of countered by the fact that you've been earning close to 10% interest income. So you've got 30% interest income minus 10% capital losses. You've done 20% returns over 3 years. It's about a 6.5% return. Last year, you got a fair chunk of that return, to be honest, but that's what bonds have done, and you've had a lot of bond people, myself included, standing up here saying, hey, bonds are interesting. We should actually look at them, and it hasn't quite been as exciting as it should be. But let's look at why that has increased. Why are yields higher in South Africa? And I think that'll explain a lot of what's going on. So when we look at what caused these moves, the first thing people talk about, and I heard it from one of the questions there, is, but South Africa's a riskier place. Obviously, bond yields should be higher. So let's go and look at what the market says. And what I've taken here is the cost of credit insurance in South Africa over a 5-year period, and I've graphed it over the same period, and I've put 2 dots today and 3 years ago. Very interestingly, what I've then done is I've actually, there's a little bit of mathematics you can do on the cost of credit insurance, and you get the probability of default. How likely is South Africa to fail over the next 5 years? And financial markets are saying about 17% chance, 17% probability. Very interestingly, if you go back 3 years, financial markets were saying 17% probability. The actual probability of default in South Africa, the likelihood that things get derailed over the next 5 years, hasn't really changed in financial markets' minds. And we're actually pricing the same sort of risks we were 3 years ago right now, notwithstanding the load shedding, the frustrations. I'm incredibly cynical right now. If you're reading my newsletters, I apologize. I am probably overly critical of government at times, but maybe not. But you know, we feel like we've been through a lot. Financial markets traded offshore, primarily out of London and New York, are actually saying to you, yeah, we think the risks are about the same as they were 5 years ago, which is very, very interesting. But then, if it's not that, what is driving our bond prices? And the first chart I want to look at is this one. And what it shows you is, firstly, this is indexed. It's not absolute levels, so you can't sort of say one is higher than the other, but what I want to look at is the growth rate. And you've got the blue line, which sort of ends at the bottom on the right-hand side. And that's the growth rate of our economy. That's the nominal growth rate over the time, indexed to 2009, and right now it's about 2.5 times the size of what it was in 2009. The orange line that sort of hockey sticks upwards is the growth rate of South African debt, of the government's debt. And you can see how in 2009, they were both indexed to be 100. Up until then, actually, the debt and the economy were growing at about the same pace. 2009, we kind of got a new finance minister, Pravin Gordhan. We got a new president, Jacob Zuma. Something changed, and we started accumulating debt at a very, very fast rate. That debt is 6.5 times what it was in 2009. So you've had this sort of explosion of debt. Now, without a commensurate growth in the economy, and that's what's putting us under pressure. Now, the government has to get someone to buy those bonds. How does the government get someone to buy those bonds? They make the interest rate high enough that actually you say, yes, bonds are attractive. And they kind of keep having to do this because they are unfortunately having to issue more bonds in a market that isn't growing. So they've kind of got to sort of force you to sell your equities, force you to sell some other investments to buy bonds. And the only way to do that is, unfortunately, with higher and higher interest rates. So from that perspective, what you've got is this crowding out effect that's been taking place, where bonds have been crowding out other investments. And in order to do that, interest rates have had to keep going higher and higher to make bonds quite attractive. That's actually a phenomena that you find in a lot of countries that find themselves in our sort of situation. To be honest, if you look across the world, when economic growth, as a result of some economic policy slows down, you typically find that fixed income becomes quite attractive. Yields go quite high, very difficult for businesses in this sort of cost of capital environment, and that puts pressure on our bond yield curve. That, unfortunately, I think is there to stay. It's very difficult for me to argue that the crowding out effect is going to slow down, but we'll get to that in a minute. The other point to note, though, is this is the US yield over the same period. And what you've got here is the US interest rates are 3% higher over that same period. South Africa is 1.22% higher. So the US has actually felt more pain. It's actually been a far worse place to be, has been US bonds than South African bonds. And that's just a function of the global cycle. I think the previous speakers were talking about it. So the key drivers for what is taking place in South African fixed income right now, less of a risk concern, it's more a concern of bonds being crowded out, and it's more a concern of global interest rates sort of pushing higher, and that is putting pressure on sort of the cost of finance across the world. So where does that all leave us? Before we go there, I just want to talk about The Simpsons, because there's always a sort of cartoon with The Simpsons and how they predicted the future. And what you've got here is the Family Jewels pawn shop. So when you're the finance minister and you can't raise any more taxes because you've kind of sort of squeezed the prune and there's no more juice left in it, and you can't at the same time raise debt because we've just seen the crowding out effect is becoming quite severe at the moment, then what do? Well, you sell the family jewels. So you go to state-owned enterprises that still have capital, and basically you say, give me that capital back as a dividend. We'll call it the Gafekra Gold Foreign Exchange Contingency Reserve Account. We tap into that, about 150 billion rand. And that's kind of what's happened, is we've gone and tapped into our capital reserves that we can still find lying around, and that, that's kind of balanced the budget sort of this year. When I look at what economists said about it, first 2/3 of economists reported within like 2 hours of the actual budget. They all came out screaming, fantastic, well done, you found a pot of money, therefore you didn't have to raise debt, we're super happy. And actually the rand strengthened, bond strengthened a little bit on the day. Next morning, the other economists, about the 1/3 who'd sort of taken a bit of time to step back and look at this, came out and said, yeah, that's interesting, but South Africa's problems aren't going away. We've got a wage bill coupled with a sort of social grant system that is unfortunately just too large for our economy. And we haven't dealt with that. So you can buy yourself probably 2 years by sort of tapping into this pot of money that you found, but in 2 years' time we're having the same discussion. And therefore, this just buys you a little bit of time. And those economists came out quite negative on what had happened. It was only about a third of them, 2/3 of them were positive. And those third then started publishing this, and you actually sort of saw bonds reverse a bit, the rand reverse a bit. At the same time, you had some offshore developments. Remember, the US economy matters quite a bit, and that kind of pushed, pushed us quite a bit weaker in terms of the rand, pushed us quite a bit weaker in terms of bond yields. So in terms of this, what has it really done? We found a pot of money, we bought ourselves 2 years at a time, but we haven't addressed the structural issues. And, in a nutshell, where does that leave us on bonds? How are we thinking about bonds within our environment, within Anchor? And the point is that, a lot of speakers have been up here before me. US interest rates are going down. Maybe they're going down a little bit slower than we thought. Maybe, it's been pushed out a bit, but they're probably going down by about 1.5%. And that is good for South African bonds. That gives us a massive tailwind within the bond sector. Secondly, our debt ratios, unfortunately, continue to go up. And every time the finance minister predicts debt ratios, it's almost like an upside-down U, and we're always on this sort of leg where debt ratios are going up. We never quite get to that flat piece, and next year the flat piece has moved out another year. But that's the reality of what we get shown. And those debt ratios are still predicted to go up. That means there will be further crowding out of investors. It means that bond yields are going to continue to be under a little bit of pressure, and that's going to be a negative. Overall, so you've got this kind of competing tug of war, the domestic factors, the domestic supply is going to be a negative overhang on bonds, but the global environment is more friendly. How are we interpreting that? Experience has taught us, and we saw it in December, we've seen it multiple times, the global environment is the stronger of the two forces. So at the moment, we expect this tug of war means that because of what's happening in the US, we will see a supportive environment for bonds, particularly in the second half of the year. Anchor's view is interest rate cuts start around about June. Anchor's view is South African interest rate cuts of about 1%. And we think that that will put us in an environment where bonds will strengthen a little bit. And why only a little bit? Because you kind of got the negative overhang that's going to hold them back from what they could potentially have done otherwise. But it means that the tide is in your favor. It means that there is a good opportunity. How are we positioned for this? We think that 2024, 2025 will be a good environment for bonds. We think you want to own sort of belly bonds, if I can put it that way. So what we're saying is don't lend money to the government until 2054. Lend it to 2030, 2037, that's far enough. You're getting enough pickup, you're getting enough yield, you're going to get nice capital gains when the bonds do actually rally. That's where you want to be. That's what you need to do. That's exactly what we're doing in our portfolios. So there is definitely upside, there is definitely opportunity. I haven't put a slide up here with the portfolio details because as soon as I do that, Eugene battles to get you CPD points. So it's always a bit of a sort of arm wrestle before we do this. Anchor BCI Fund, Anchor BCI Bond Fund is the portfolio I want to mention. It's outperformed the all bond index quite reasonably over time. It is a portfolio that is designed right now. It's taking those sort of 2037 bonds. We're very underweight the 2054s. Our models are screaming at us saying you're crazy, but I just can't bring myself to lock in for that long period. So it is a defensively positioned bond fund that actually outperformed the all bond index last year. So it does, it does bring something to the table. And with that, I'm going to stop. I see I'm a few minutes early. Sorry about that, guys. And say to you, Saffron, how do I do this? Do I just keep going? Do I hand over to you? I'll stop. Okay. So we've over to Brandon Quinn. Sorry.
Yes.
My name is Brandon Quinn, and I'm joined here by Anina Swickers, my co-portfolio manager. Unfortunately, family commitments have made it impossible to attend the BCI conference, which we would have very much liked to have caught up with our Gauteng and Pretoria investors. However, hopefully this presentation goes some way to achieving at least part of that. Saffron manages strategies across all the major risk quadrants. In the low risk quadrant, we've got the Opportunity Income Fund. In the medium risk quadrant, we've got our Active Bond Fund and our Global Income Fund, which is a dollar-based income fund, UCITS fund based in Ireland. And of course, in the high risk quadrant, we've got our hedge fund as well as our BCI Flexible Equity Fund. As far as a small boutique asset manager is concerned, we're very well resourced. All of the team have either honors or master's degrees in finance or risk management, and many of them either have or are progressing to completing their CFAs. Today we're going to talk predominantly about our Opportunity Income Fund and our Active Bond Fund. Our Opportunity Income Fund has a cash +2, a STEFI +2 benchmark, whilst our Active Bond Fund attempts and does in fact outperform the Orbi Total Return Index. Our Active Bond Fund has grown very pleasingly over the last year and a half, and now has north of 1.3 billion assets under management, whilst our income strategies, so that includes both our unit trusts and our segregated mandates, has north of 2.5 billion under management. Looking at the performance over 1 year, our Opportunity Income Fund delivered 10.5% after fees. And that, of course, is the most expensive fee class, which is a 1% fee class. So the performance is very good against an SA multi-asset income average of about 8.82%. Over 3 years, Opportunity Income came in at 7.95 versus an average of 7.13. And over 5 years, Opportunity Income achieved just north of 8% against an average of approximately 7%. Interestingly, over the very long term, so actually the fund has been around for more than 13 years, but in terms of the 10-year track record, Opportunity Income has delivered 8.28 on an annualized basis. Important to remember that, whereas the average in the category returns 7.27. So a full percent for 10 years, 10 years every year, as it were. Looking at our Active Bond Fund, had a very good year last year, and particularly in bond space, returned 8.64% versus a 6.93% average. Over 3 years, almost 9% from our Active Bond versus 7.3% from the SA bond average. Over 5 years, our Active Bond returned 9.1% versus the average of approximately just north of 7%. And over 10 years, our Active Bond has returned almost 8.5% versus 7.8% from the average. So I think that one can take from this that our active positioning and risk management tends to deliver our performance both over the short term as well as over the long term. And now for our fixed income outlook for 2024. Thank you, Nina.
Thanks, Brandon. So to start off, we tend to look at the global market environment and then narrow down to SA specific, also look at our EM peers. But for this presentation, we'll show you key factors that we monitor and our views on those key factors. So dollar index, for example, DXY index, you can see it's quite a volatile index, but since the beginning of 2023 up until recently, it's been trading in quite a range, and that range has been driven by the uncertainty in the rate environment. If we look at the US FRA curve, which is on the next slide, the bars at the bottom show you the probability of a change in a 50 bp cut or hike in the black bar scenario. But you can see, for example, the dark gray bars indicated at one point, which is 1 month ago, it indicated that US rate curves were expected to be cut by nearly 4 times 50 bips, which is nearly 2% in the next couple of months. But as US macro releases persuaded the market differently, you can see how rate cut expectations have since come in quite significantly. So currently, as a max, the US rate curve is only expected to decrease by 3 times 50 bips, but so that's 1.5%. So it's coming quite significantly, and we see the market fluctuate quite significantly on macro releases. It
And I
has
think,
been.
sorry, Nina. Yeah, and I think our view has been for a no landing rather than a soft landing for quite some time. And as a result of that, we've kept our global fund, our dollar fund, rather short, with approximately 60% in US Treasuries, harvesting a very, very high, nice, high short end rate for very, very low additional, for very, very low duration.
Yeah, we've been holding the view that the market was far too optimistic when it came to rate cuts. The expectation was for rate cuts to start happening in the first half of this year, but it's highly unlikely that we'll see cuts in the first 6 months of 2024. On the next slide, we look at US CPI expectations, so it's US inflation. And you can see the blue line, the dark blue line, that starts just after 2022. That's the average inflation expected for 2024. So you can see that the US Fed targets a 2% inflation rate, but you can see that that line is not approaching 2%. Or close to 2%. And looking at that short black line, that's the expectation for 2025. That also does not approach 2%. So it's just an indication that the US inflation expectations are not really supporting lower US rates at this point in time.
Just statistically, to build on what Anina said there, is that as these rates have come off, so the reliance on base effects to bring them lower statistically becomes less probable. And you can see that small bounce fairly recently in the US inflation. And that really is creating a very adverse base from which to move forward from. So base effects definitely are not as, or are going to be less supportive going forward. And the closer they get towards that target rate of 2%, the disproportionately more difficult it becomes to achieve or actually go through it.
And then if we look at the SA rate curve or rate expectations, SA rate curve is much flatter than that of the US, so not pricing in nearly as many rate cuts as the US or our other developed markets. So you can see again the dark gray bar, which is the rate expectations 1 month ago, was pricing in a lot more cuts than what we're currently seeing. So currently it's, if you look at the red bar, you can see that it's, we maxing out at 225 per cut, so that's only 0.5% lower expected in the next 2 years, which is not that significant. And again, we've been holding the view that even for SA rate cut expectations were too optimistic, and we still of that view. We see that there's a lot of risk to inflation, risk to the upside. And that's predominantly determined by the global commodity demand and some geopolitical risks. So a lot of uncertainty, and SA is unfortunately quite dependent on what's happening in the global market environment. If we look at this, is just to put it into context, but basically it's just highlighting. Red line is the SA FRA curve, or the number of cuts that's expected in the SA rate environment. Black line is the US that we looked at earlier, and the gray line is the EU FRA curve. So we can see that SA is pricing in a lot less cuts than the developed markets. It should be supportive for our rate environment, but that's only if it plays out like this. So
And certainly it maintains our global competitiveness with regard to the carry trade.
Yes.
And I think that's very much factored in here, is that we can't really afford to drop our rates too far or too rapidly, even if we don't have the backdrop of supportive growth. Simply because we need to be paying for those foreign capital flows, those hot capital flows, as it were, by providing investors with higher interest rates. So I think on balance, the interest rate market bonds, money market, is a very attractive space to be in a low growth environment, which South Africa is characterized by at the moment, and likely to continue for the foreseeable future.
Yeah, this chart just highlights again the move in SA inflation rates. And again, the dark blue line is the average inflation expected for 2024. And we can see that that averages around 5%. So it's still above the 4.5% target. And then in 2025, which is the short black line, inflation is expected to approach 4.5%. But that's still yeah, that is literally in the middle of the 3 to 6% target range. So inflation not expected to come much lower, especially in the next 2 years. Yeah, so our Rand outlook, if we can just put the dependency of the Rand into context. So this the red line is the 1 year percentage change of the dollar Rand, and the black and the blue lines show the CRB indices, their performance over a rolling 1 year basis. And you can see how those lines closely track each other over time. And what this shows is that SA or the strength of the Rand is very dependent on the global commodity environment and demand for global commodities. So the China story and China's recovery and their demand for commodities will have a massive impact on the Rand going forward, and the Rand will be quite dependent on the outcome of China recovering.
In fact, the only bullish scenario that we can fathom at this point in time that could result in a stronger Rand, despite in addition to perhaps holding our rates constant whilst the rest of the world decreases their rates, the only scenario that we could see that could improve our fiscus, our currency flows, and indeed the Rand, is massive intervention on the part of the Chinese central bank. That is the outlying scenario that could well bring the Rand back by an extraordinary amount. But the likelihood of that scenario still remains an outlier.
Then Brad, maybe if you want to continue with the credit spreads.
If we're looking at global credit spreads, emerging market and developed markets credit spreads, and here we've got the iTraxx, which is the Euro basket of corporates, versus the MB, which is a combination of sovereign and corporate debt, but somewhat more Latin American focused. You can see that the spreads are approaching expensive levels, especially considering the global backdrop. And whilst they have got more expensive in the past, these kind of levels do not appear to offer us value. And as a consequence of that, we are slowly but surely shortening our credit exposure, with the expectation that we're likely to get better opportunities in the future. And looking at our SA rate curves, you can see the red curve there. That's our South African government bond curve. We still see value around the 12 to 15 year area, where the curve achieves its steepest point. And yeah, that point in the curve is still offering decent value, even on a risk-adjusted basis. We don't believe that that the value very, very far out is adequate in the 2046s and the 2050s, thereabouts. So our position tends to be in the region of that 15-year area, where we believe the yields are the most attractive on a risk-adjusted basis. What does that mean for our funds? So our funds right now, Opportunity Income, has a gross run yield of almost 10.9%. We expect that to lift slightly in the future as we deploy more cash. And the best scenario that we can see right now, the most realistic scenario that seems to be playing out, is of course the sideways movements in rates. So, the recent uptick in US rates and the change in expectations was very much consistent with our 6 to 12-month view. So we're kind of 6 months into our 12-month view here. And we still think it can go sideways for some time, with, of course, a little bit of oscillation to keep it interesting. So over a year, we would well expect, a 10, late 10s, early 11s, maybe 11, 15 type return for our opportunity income fund. And bearing in mind that the modified duration there is only approximately 1 year. Looking at our active bond fund, and this is, of course, where we utilize a lot more duration, a lot more active duration. The gross running yield is sitting at approximately 12%. And this is with a modified duration of 4.15, bearing in mind that the all bond index has a duration of almost 5.7. It's offering substantial value versus the much heavier duration of the all bond index. And now to talk about our retention funds. As you may or may not know, some of the Saffron funds have exposure to the red ink remote SPV that has bridge taxi as the underlying borrower. And whilst our instruments have not, and it's important to remember this, have not missed a coupon to date, the business backdrop of bridge taxi has deteriorated significantly. Our opportunity income fund holds about 3.4% in the special purpose vehicle, and our active bond fund holds about 2.5%. As a result of this, and with the focus on treating all customers fairly, and to some degree to be consistent with the approach of other asset managers that have already implemented the retention funds, we have decided to follow suit and also side pocket our bridge holdings. BCI will shortly be issuing correspondence in this regard, importantly dealing with implementation dates. We believe this will protect both our long-standing investors and the steady stream of new investors that are entering into our funds, whilst we engage actively with the issuer to maximize the recovery of our interest in capital. Our funds remain liquid with robust risk management and active market positioning, which will continue to deliver the kind of outperformance that has come to be expected of our Saffron funds. If we look at our performance over the last year, our opportunity income fund at 10.5 versus our active bond fund at 8.6. Again, please bear in mind that these are the most expensive classes of 1% each. They have beaten the average peer by about 1.68% and 1.7%. Assuming a conservative recovery of our notes of about 50%, and bearing in mind it is purely an assumption at this point, our effective exposure diminishes to 1.7 and 1.25%. This means that over the next year, assuming our outperformance remains steady at the kind of levels that we have achieved both last year and in the past, the recovery period, and I can't stress enough, the recovery period based on the outperformance over peers will be approximately 1 year and 0.9 years, respectively, for our opportunity income and our active bond fund. Thank you very much for your time. As always, you'll know that the Saffron team is easily contactable. So if you have any questions, either send them directly to myself and Nina or to info@saffronwealth.com, and we'll be most glad to field them. We hope you enjoy the rest of the conference. Take care.
Cool. Thank you.
Nolan, even if Brandon is not here, it takes more time. Can you believe that? Right. Just before we break for tea, Nolan, very quick question. Bond returns, total returns over the past 3-4 years, it only came from yield. The capital valuations actually were in the red. It didn't contribute to total returns. What probability would you allocate for 2024 that we might see some greens in terms of capital gains on bonds?
I think the message I was trying to give was that circumstances are now different. Specifically with regard to the US interest rates coming down. It's interesting, Brandon and I are both talking about 1.5% lower yields in the USA. That will be supportive, and I think Probability is probably 60 to 70% that you'll see some small, and I stress the word small, it's not going to be runaway capital gains, but you're going to see small capital gains, which means for the first time in about 3 years, you're going to have your interest income, 10, 12%, plus a little bit of a capital gain. That's why we like bonds.
Donald, thank you for that. One question quickly, Tia.
One of the biggest challenges we have in South Africa relates to this idea that the CDS spread prices probability to thing. Because when we say that South Africa has a high probability of default, it's not reflected in the actual empirical evidence, okay? Because our probability of default has been the same as Brazil for many years. Brazil has defaulted 3 or 4 times in the last 20 years, and South Africa has actually never defaulted on its debt. So the question I have is, if the global market prices our probability of default at an inflated level, isn't it the responsibility of SA asset managers to actually correct that, let's call it negative pessimism? Because we have never defaulted on our debt, and yet we priced comparable to countries that are basket cases.
All right, interesting question. Okay, so kick it off with a couple of comments. Brazil's actually never defaulted, by the way. You're probably thinking Argentina or Venezuela. The reality is, in fact, Brazil's credit default spreads are lower than ours. Their probability of defaults probably, and I'm doing some mental math here, somewhere around about 14% in the market. We're at 17%. So the market sees us as a more risky proposition, notwithstanding the fact that Brazil is going back to the future. They're probably going to have Lula back in as president, and he's like the guy they kicked out for corruption a couple of years ago. But so they've got challenges. Is it a perfect science? Absolutely not. But there are definite trends you can notice. I think the reality is if you look at defaults on the corporate side, Lehman Brothers, the market was very good actually, and the default swap market moved significantly way before the default. In fact, I remember people coming up to me and saying this 20% probability of default is ridiculous. No, it wasn't. And there are certain unique situations in South Africa. I think we are lacking confidence from the investor community right now. We've been going out with the same story, that upside down view of our debt level is going to rise, and they're going to flatten out, then they're going to come down. They never flatten out, they never come down. And consequently, global investors are just saying, look, it's the same old story year in and year out, and we never actually see what's happening. And there's a sense of disappointment. And that is being reflected in the default spreads, default probabilities. Different to Brazil, where Lula is able to go in there and promise that he's going to clamp down on corruption, albeit he was like the key guy in corruption 10 years ago. Somehow the market is buying this, and we're seeing a stronger commitment to structural reform that we just are not actually able to do here in SA. So that's kind of what's driving the difference in price. Is it a perfect science? No, but it's kind of as good a measure as we've got. And I think the message coming out of it is that the default, or the message I was trying to portray, is that the probability of default, certainly from a global investor environment, really hasn't changed much in South Africa over the last 3 years. They kind of see us as risky as they did 3 years ago, and it's actually other factors that have been driving the bonds.
Very interesting. We don't always feel that on the ground, but there's the evidence. Exactly.
In London, it's more positive than we are here, actually, which is something we definitely do feel with Anchor's London office. But thank you.
Good stuff. Nona, thank you so much for being here today. We really appreciate it. Although we gave you less time, we're going to give you more time next time. I think let's get going. Thank you all for coming in so quickly. I do appreciate it. We're going to continue with fixed income, but certainly in the multi-asset flexible fixed income space. This is great solutions. If you don't want to make the call between duration or floating and fixed rate notes, or more credit or less credit, or all those kind of things, or ILBs or not, these are the managers that can manage it on your behalf and that of your clients. So already on stage, very welcome, Melanie Stockett from Laurium Capital, Sydney from Cadis Asset Management, and JP from Methodical. Thank you all for being here this morning, and we're looking forward to your presentations. Melanie, you first. Thank you.
Well, Thank you so much. Good morning, everyone, and thank you so much to BCI for the opportunity to be with you today. So what I thought I would do in my session today is just run through, you've probably had, where's the screen over there? You've probably had lots of discussions about landings so far today, and you'll probably have the same this afternoon. So what I thought I would do was position what we think we as a market need to land this year from a fixed income point of view. So just to start off on the global stage, let's just take a moment and position where we are in the global cycle within a fixed income perspective. So we had COVID, we then had this massive surge in inflation, we then had central banks respond to the rise in inflation by increasing interest rates. It took them a little while to get out the starting blocks, but then they started to move, and they moved quite quickly. And the Federal Reserve in the United States started to lift US interest rates in March 2022. Now, economists tell us that it takes about 18 to 24 months for interest rate hikes to start to impact the economy. So if you take March 2022 and you roll forward 2 years to March 2024, you can see that this landing zone lies ahead of us this year. And the question we're obviously all grappling with in the market is, what type of landing is this going to look like? Is it going to be a landing where the cumulative impact of interest rate hikes slows the economy below trend, but in a measured way, and inflation comes back to target? That would be a soft landing. Or is it going to be a landing where something breaks? Every time the Fed raises interest rates, we know in the past something has broken. Is that going to be something big, something small? Are we going to lose an engine? Are we going to crash land into a recession? So these are the scenarios that we're faced with this year. And how US bond yields will react to these two scenarios will be very different. In the first scenario, the soft landing, we're going to see US yields trade within a trading range. We're probably at the top end of that now. The Fed will start to cut interest rates, but they'll be slow, they'll be measured, they'll be cautious, and they'll cut rates back to probably where their neutral is, so somewhere from 5.5, somewhere to maybe 2.5 to 3 over a period of time. However, if we have a hard landing, that will be a different scenario. So we'll see US Treasuries rally, the Fed will cut interest rates proactively, aggressively to prop up growth, and emerging markets might and risky assets might have a little bit of a difficult initial period in that cycle. What's important is that the conversation we've had up until this point now is very different to the conversation we would have had a year ago. So last year, we as fixed income managers, we were talking the whole time about how we were in a Fed hiking cycle, and we didn't know where the Fed was going to stop. We didn't know where this elusive peak in the Fed tightening cycle was going to be. Roll forward a year, and we're not talking about if interest rates will be cut. We were talking about when they'll be cut and how deep will that cutting cycle be. Very, very different psychology for bond investors when Fed is hiking rates versus when Fed is cutting rates. So that's support number one. Support number two is that if you look at global bond yields here, I've taken the US 10-year yield issued by the US government, and I've taken it back in time, all the way in history. And if you look pre-global financial crisis, 2007, 2008, you can see that the US 10-year traded in a range of 4 to 5%. We then had the global financial crisis, yields rallied with extraordinary stimulus, culminating in COVID when US yields were close to 0% and developed market bond yields were negative all over the world. Bond yields were a grudge purchase in your portfolio. If you were a global asset allocator, there was an opportunity cost to holding bonds. Since then, obviously, we've had the rise in inflation, the rise in interest rates, and bond yields are all the way back to where they were pre-GFC. So bonds actually add value. They offer value to you as a global manager in terms of portfolio construction. Value has been restored. That's another really important anchor. So you might ask, why do global yields need any of these anchors this year? And this is a year where you can see on the left hand, half of the world is voting. So it's the largest percentage of the global population that's ever voted in a single year. And if you look at it from a GDP perspective, these are big countries. Basically every man and his dog is voting. And these are countries that matter. So it's more than 50% of global GDP. And why this is important is if you look at the right-hand chart, this is a geopolitical risk index, which Citigroup have put together. And you can have a look. This index starts with September 11 as the first spike, and then the Iraq invasion in 2003. After those episodes, geopolitical risk was really low heartbeat, year after year after year. This all changed when Russia invaded Ukraine in 2022. You can see the spike towards the end, and obviously when Hamas attacked Israel towards the end of last year. So the risk of escalation of this index is higher than it's been for decades. This is a time when you really need to have sensible global leaders gathered around the negotiating table, which is why elections are so important. And talking about sensible global leaders, one of these elections that we need to land this year is obviously the US election in November. Is this going to be a soft landing or is this going to be a hard landing, right? We don't know. Is it going to be Trump? Is it going to be Biden? What we do know is that the dynamic that Trump brings to the political space is one where if I win, you have to lose and you have to lose badly. It's one where he doesn't have political foes or adversaries, he's got political enemies. He has very little regard for independent institutions or for global world order. So you could say to me, Mal, what are you worried about? You're stressing about nothing. We had Trump before, nothing happened, the markets did quite well. Storm in a teacup, and you might be absolutely right. But there are a couple of differences this time round, and some of them would be that geopolitical risk index that we've just been talking about. The risk of miscalculation right now is just so very high. There's so much dry tinder around the world. This isn't an environment you want to strike a match and set a light to, right? Secondly, if you think about the US fiscal supports that we had pre-COVID, US debt to GDP accelerated through the COVID period because of all the stimulus that's been provided to the economy, which is obviously one of the reasons why the economy has been so strong. But debt investors need to fund that, and bond investors, they think really carefully about institutional strength when they invest in a country. And the third key difference in my mind would be that global supply chains were so broken after COVID. We all know what happened there. It took a while to be restored. They're vulnerable once again to the Red Sea, the conflict we're seeing in the Red Sea and the Middle East. If you bring Trump into the dynamic with his trade wars, trade tariffs, trade barriers, let's just say that the global environment is less forgiving, I think, this time round than the first time, and valuation buffers are really, really important. The other election we need to land this year closer to home is obviously South African elections. I don't need to tell anyone in the room about that. Looking at elections through a fixed income lens, what is important to us as fixed income managers? Have a look at all the institutions on the right. We as bond managers, we think a lot about inflation and interest rates. We need the stability and the policy continuity that's present at the SARB. The SARB is an inflation targeting central bank, and they're very good at their job. We need that to continue post-elections. National Treasury, they're the guardian of our purse strings. We need to have responsible people at the helm who can hold the fiscal consolidation line as they have up until this point. Operation Vulandlela, they're responsible for all the growth reforms we've seen lately. That's almost like a task team, operational task team that sits within the presidency. We would want to see some continuity of their reform progress post-elections. And then, obviously, when we think about foreign policy, we all saw last year, during the Lady R saga, just how foreign policy, if it's handled badly, can shoot you in the foot. Given the global context, we really need to see some sensible foreign policy post-elections. What is the likely scenario? The most likely is probably the most boring. ANC loses support below 50%, but falls to a zone where they can cobble together a coalition partner who is more like-minded. That's most likely, but obviously there are tail risks on either side of that, which we need to think about very carefully. The last landing I'd like to discuss is the South African growth landing, and this might be where we've got slightly better news. So let's just think about South African growth for a moment. Let's put it into context. Since 2012, the South African economy has grown on an average of 3%, 2%, nowhere near that. It's been less than 1%, 0.8% since 2012. And as an emerging market, we should hang our heads in shame. I mean, it's deeply embarrassing. That's not EM growth, right? We all know the reasons for it. We had the last decade under Zuma, lots of policy uncertainty, but the big potholes that we've had to navigate recently have been Eskom and Transnet. Now, these are arteries that carry oxygen to the global economy. These are really, really, really important and critical institutions. And to give you a feeling of context, it's estimated that Eskom has taken 1% to 2% off growth, South African growth rate, in recent years. That's a huge clip. And Transnet alone could take as much as 1% off this year. These are big numbers. The good news, though, is that we think that the hard landing is behind us. In the electricity sector, The fact that the gatekeepers have been lifted and the private sector is coming in, we are a lot more optimistic about the outlook. We think load shedding will be a lot less this year than last year. Next year will be better than this year. And Transnet is probably about 1.5 years behind Eskom, but the National Logistics Freight Roadmap is a really good one. Everyone is at the table to roll up their sleeves and get working. The private sector is being included, and we're very optimistic on the outlook there. So we do think that that hard landing is past, but it takes a while to show up in the growth numbers. The same on the fiscal side. Our debt to GDP is just too high. The only way we're going to get fiscally sustainable again and bring that down is if we grow the economy and grow the revenues that we can achieve from the economy. So growth is so important from the South African context. So that's a lot about risks. What about returns, potential returns? So this would have been discussed, I think, in the earlier panel, but essentially this is our South African yield curve. Do we want to hold any bonds in our multi-asset income funds? You know, what's the point given all the risks? And you can immediately see this is the yield curve. So we've got time to maturity on the x-axis, we've got yields on the y-axis, and you can see immediately that the curve is very steep. It's probably the steepest in the world. Yields are really, really high. Why is this relevant? It's relevant when you do the maths of should you be including bonds or not. And here what I've done very simplistically is I've taken a 10-year, 11-year maturity bond yield, the 2035, trading at around 11.6%. You know, if you buy this bond today and you hold it for a year, your income return is going to be 11.6. That's not going to change. What will change is whether you have a capital loss, which reduces your total return from your income, or whether you have a capital gain, which adds to that. That's all you need to think about. So what type of scenarios can we run? If yields were to rise a full % over the next year, so from 11.6 to 12.6, and you exit in a year, you can see that's a second dotted line from the top. We've touched on that before during COVID and then last year into big risk-off events globally, but hasn't stayed there. But let's just say it did stay there. You would generate a 6% return from that bond, which is very close to cash, right? That's not an unpleasant outcome. And if it were to rise a full % further, so 2% from current levels, you would still have a positive return from this bond. At the same time, you just need a really small rally, just bonds to rally a little bit, 0.5%, and you get close to a 15% total return. So that's why we would be talking about including bonds in our portfolio construction. But having said that, you really need to choose your exposure across the curve very carefully, and you need to be active in switching that exposure when you see better value in one area or another. I'm here to talk about the BCI Strategic, Lorien BCI Strategic Income Fund today. You can see we do very actively manage our portfolio duration in the portfolio. And we want to achieve two things out of our portfolio returns. We want to provide compelling returns relative to cash. Here we've got 10-year track record in the fund. You can see the returns on the right-hand side. But we want to do it with capital preservation mindset in mind at all times. So we really want to limit the negative return months we have. 95% in this very long track record has all been positive, and if we ever have a negative month, the following month we've had a strong bounce back. That to us is important, and it's doing exactly what we promised to investors. Given all the risks that we've discussed today, what you want to find is you want to find portfolio managers who've got lots of experience, portfolio management team who's seen a lot of different cycles, has the ability to be flexible, to be active, and to be able to manage risks and look for opportunities that are presented in the current environment. And we think that boutique managers like ourselves are very well positioned for that. Thank you very much.
Okay, spectacles. Thanks, BCI, for having me, and thanks, Melanie. I love the aviation theme. I think it was really nice. All right, but I'm here to talk about fixed income. Sorry, I'm Sydney McKinnon from Katie's Asset Management, and I'm here to talk about fixed income. So let me just find my slide quickly. Okay, Melanie's got all the disclaimers. There we go. All right, so I'm here to talk about fixed income, but let me just start off by saying that in any financial market, whatever you're trying to invest in, you want to pick the winners. You don't like losing. So I thought I'd entitle my presentation today, Everybody Loves a Winner. Now, and we know that being here in Pretoria. But the scientists say it's here in the brain. It's a chemical or a hormone. So if you win, it gives you pleasure. I think they call it dopamine. So if you win, you have this pleasurable feeling of winning, and it's a chemical reaction in the brain. But the scientists also say that the pain of losing is greater than the joy of winning. You know, they did some studies where they took the pictures of the guys who came second, guys or girls, let me be politically correct, second as opposed to first. And man, those guys, it's a stark difference. Even the guys who come third feel better than the guys who came second. So it's a strange story, but here we are in the financial world, and we're trying to be able to pick the winners, especially and I'm here to talk about fixed income. But at the end of the day, you know, I say, I don't manage money. I manage two things. The one is expectation, if I can give you what you expect in whatever field I'm working in. And the second one is risk. Can you do it within the risk parameters? And speaking of risk, you know, I had a look at the World Economic Global Risk Perception Survey that came out, I think it was last month. And I found something quite astonishing in that over the next 2 years, and even I think it's 10 years, the perception of the major risks that face us is not the economic risk as we thought it might be. And we heard a lot about it today. You know, I'm going to repeat some, but forgive me for that. But we heard a lot about this risks, and strangely enough, it's misinformation and disinformation and extreme weather conditions. Those are on the top. The economic stuff seemed to go a little bit lower down. I think inflation and the like is at position 6 or 7. But I think the important thing is these things affect us as fixed income managers, any manager, anyway. So I think we have to be cognizant of the risk, and I think Mel spoke about the risk earlier on as well. So I thought, let's look at what we know. And I know our son that, or our friend, our son that was born here in Pretoria, he asked us, what do we know, wat weet ons? En ons weet nie wat, ek hoop ons weet wat ons weet. So what do we know about global growth? And a lot has been said about it today. It's been resilient in major economies, but resilient in a very muted way. And a lot has been spoken about disinflation over the morning. So we've seen disinflation globally, and Mel spoke a lot about landing, and I think we've had that likelihood of a hard landing receding globally. But there's risks in the system. You know, we could have commodity price spikes again. We could have attacks in the Red Sea happening again. You know, the supply chain disruption. Ships have to change course come around Cape Town if we can accommodate them. And then China has been spoken about China and the deepening woes in the property market. So growth has been resilient, but it's been muted. And if you look at the IMF's growth projections for developed and emerging economies, we'll see that it's still fairly low numbers. You know, the global economy is only going to grow just over 3% in the next year or two. And advanced economies markedly less so. If you're part of an emerging economy, not South Africa, I think, but part of an emerging economy, the prospects seem a little better, but of course the risk also higher as well. So that's what we know about global growth. So what do we know about global inflation? It's projected to decline over the next 2 years, and we know why. Because we've had this diminished inflation is reflective of the fading out of relative price shocks, and then we also had the labor market that's been easing, and then of course wage growth as well that's generally remained contained. So this is stuff we know. So I mean, we've heard a lot about it this morning, but it's important to know what is going on around you. So what about monetary policy? I think the central banks around the world have got a very difficult task. It's really a delicate task to implement monetary policy at this point in time. I think there's a lot of high levels of uncertainty. How long is the inflationary pressures going to remain in the system? How long are they going to keep rates, as one of my colleagues said this morning, sort of at that peak before the actual cuts start happening? So there's lots of structural forces at play, the deglobalization, the climate crisis, I've mentioned that earlier on. And then I think one of the economists of HSB said most central banks are relieved their most aggressive tightening in 4 decades now appears to be over. So yes, there is relief, but what now? What happens now? What are you actually going to do now? And I think the balance is very delicate in terms of monetary policy that needs to be applied, that you don't cut rates too soon, and that you also don't leave it too long. So I think we know we're sort of in that delicate balance situation at the moment. Then just bringing things closer to home, what do we know about our local growth? Okay, so we've seen GDP undershoot all the forecasts, okay, on a quarter-on-quarter seasonally adjusted basis. And so there's a couple of reasons for this, but the one was agriculture. That was the big one that contracted. And then we saw the non-agricultural sector being a bit more resilient, but that has also been susceptible to fuel price, petrol price changes in the fuel price and oil price. So you know that economic growth for 2023, and I think Mel said it earlier on, and when the numbers eventually do come out, we're all expecting that to be below 1%. That we know, okay, and we even expect that as well. So, and our weak growth is underpinned by the factors that we all know has been spoken to death about this morning. So high unemployment, we've got electricity problems, low business confidence, low consumer confidence. I can carry on. So we have that issue in our growth. But theoretically, in a bond environment, then that should keep a lid on yields, but that's in theory, okay? So we just have to see, because the bond market is affected by many factors that influence the directional movement of interest rate. It's not only growth. There's lots of economic fundamentals, which is important. And the gentleman asked the question early on about CDS spreads. I mean, so yeah, we're not reflective of where we should be theoretically, but there's other factors at play. And I think the important thing to realize is not one factor. We all got our hot buttons. We all like the rand, or we all like growth, or we all like the political intervention. But at the end of the day, the prices that get reflected in the fixed income market or any financial market is a combination or a combination of many factors, some more affecting the price than others at any one point in time. So what do we know about local inflation? I don't need to tell you. So we saw inflation coming off, okay, and then we saw inflation starting to tick up in the last one or two readings that we've had. But that was largely, I think, due to the fuel prices that added a bit of volatility in there. And then this thing called core inflation. So you strip out everything else and you land up with core inflation. And you've got the stickiness of core inflation, which I think is quite important now. And it's going to reflect in the instruments that we deal with in the fixed income environment, because a large part of the price within, for example, a bond is inflation expectations that is embedded in that yield to maturity, and that we've seen a bit of moderation in the food prices, but of course that can be very cyclical, weather dependent. So the other thing I want to mention is the mathematics. So last year, I think when I stood on one of these platforms, I said inflation's coming off a higher base. Yes, we know that. But now that base has been eroded, so or it's moved. Time has moved away from that. So we're coming off a low base. So mathematically, it's not as easy for low inflation on a year-on-year basis as it was a year ago. It's just in the maths, okay? So we know that. And then what about our beloved rand now? I think it was spoken about the rand early on, but our rand is one of the most liquid currencies across the world. It is traded quite easily anywhere, almost anywhere in the world. And I think that's why we're so susceptible to price shocks. And I put on the screen all the events that happen, whether it's monetary policy committees or oil price changes and that kind of thing. It affects rand. So we're going to get more volatility going forward. That's for certain. That we do know. And we've also not been the beneficiary of emerging market currency strength. Or, when emerging market currencies have strength, we actually haven't. Why is that? And maybe it's one of the same reasons that we spoke about when we spoke about credit default swap rates earlier on. We've got so many other factors that are influencing our currency and the negativity surrounding it. So the implied volatilities of our currency is quite high. And we just had the budget, but the deteriorating government finances are not helping us. All right, so that is the rand. What do we know about monetary policy? I mean, that's feeding into from the budget. I think we know that global inflation has decelerated. But the SARB has emphasized time and again, as you know, our government always says, however, the risk to the upside in inflation is to the upside, okay? So they haven't quite quieted down about the considerations or the concerns, let me put it that way, that they have as far as inflation is concerned. So our SARB also has a delicate balance that it needs to take, or delicate decisions that it needs to make as to when interest rates are going to be cut. And I think it will be very data dependent. They need to see the hard data and then, of course, debate it. And the tone is still hawkish at this point in time. One last thing I want to mention, and this was also spoken about, is credit spreads. Coming back to this. In our fixed income environment, we've seen the spreads narrow and just continue to narrow, except for the municipalities and the state-owned enterprise. Now, somebody up here this morning earlier said, well, things are turning or changing. I really hope so. At the moment, it's still very hard for me to see that, and I need a bit of convincing, but at the moment it's become expensive to get involved in our corporate market. It's become expensive to buy the credit, and of course the risk that goes along with that. It's one of the other things we have to contend with. The yield curve, let me not spend too much time on the yield curve, but the yield curve, we know there's value in the belly, everybody agrees, and in the back end we're prepared to take the risk. So yes, and we got nice real yields. So guys, the bond market, yes, there's opportunity in it. Don't deny one of the most important asset classes on the planet. So as I said earlier on, everybody loves a winner. So who are the winners, as they say in the Oscars or the Grammys? And the winners are, ladies and gentlemen, in the category of asset class returns in South Africa, and I'm a fixed income guy, so I'm biased. If I have to vote on those things, then I'm biased. So just looking at 2023, and the blue line is equities, or the all-share index, a total return basis, and the purplish line, that's your cash line, and the brown line is property. And over 2023, bonds have done very, very well. I've made the red line a little thicker, but that's because I'm biased. So, you know, if you so bonds have done well, unless you had the gumption to get involved in the property, brave enough to get involved in the property market. Property just picked PIP bonds by the end of last year. And if you take it back 5 years, then what do you know? The bonds with less volatility has given you, or the All Bond Index has given you the same, or if not slightly better returns than equity. So another reason to get involved in the asset class. At Katie's, we follow a level of conviction, as any good manager should have a investment process. And this is just a depiction of that. The repo rate is the solid line, and where we've been short as the rates have been going up. And now our process is telling us to get involved in bonds and a little bit more duration. And that's what that slide is trying to say. So a little bit of marketing about our products. We've got an enhanced income fund. We're in the space that I'm talking about today. We have 2 funds. It's a Regulation 28 fund, very substantial. It uses largely credit, and as all clever people do, they draw 4 quadrants, and you must be in the upper left-hand quadrant. And the guys would do their thesis, master's thesis, and everything. But effectively, the fund tries to be, for the least amount of risk, give you the most amount of reward. So I'd urge you to have a look at the numbers. Otherwise, that man's there going to kick me off the stage. I'll spend too much time on the stage. And then we've got our absolute yield fund, also Regulation 28 compliant, uses more bonds, and the relative variation of return as far as bonds are concerned, also very competitive in terms of its performance. So, ladies and gentlemen, if we didn't know, I think after this morning a lot has been spoken. As ons nie geweet het nie, wat ons weet nie, nou weet ons, né? So, if we didn't know, now we know. Thank you. Okay.
Thank you, Sydney. Let me just get to my slides here. Okay, good. Are we still morning? Yes, we're still morning. My name is JP du Plessis. I'm the fixed income head of the fixed income franchise at Methodical Investment Management. Just one slide on the company, and then I'll talk a little bit about what everybody else has been talking about, hopefully with slightly different perspective. But Methodical's been going for 8 years, focused on the retail space, not on institutional space. I always like to say I know all of my clients, and that is true. I was tested the other day actually, but I do actually know all of the clients that are invested in my funds. About 8 billion under management. I joined 3 years ago to start the fixed income franchise. We now have a range of funds, income fund and a bond fund. We've grown the assets in that franchise quite nicely over the last 3 years. So yeah, that's a bit about the company. Having watched a lot of the presentations today, I'm going to try not to bore you to tears about what everybody else has said, because a lot of the ground has been covered. But I thought I'd talk a little bit about the US and what's going on there. And I think it is a very important market for the base, creating the base for what our market does. So when the US sneezes, the rest of the world catches a cold, and that continues to be true. And then I'll reflect what that means for our market. So the trillion-dollar question, or the multi-trillion-dollar question, is what's going to happen in the US. The US has a lot of debt. If you look at the US debt clock website, it'll tell you exactly how much debt is there. It's about $102,000 for every person in the US, $102,000, and $230,000 for every taxpayer. So it's got a lot of debt. It's managed to accumulate that at a relatively low cost, because the rest of the world has bought US Treasuries and was happy to buy US Treasuries on a sort of non-economic basis. So they were buying US Treasuries because they wanted to manipulate their own currency or park dollars that they were earning on oil. A lot of different factors that helped to finance the US government over the years. I would contend with the global risks that we're now facing, that it's becoming less and less easy for the US to finance its debt. I'm not telling you that they're going to default. And the Japanese bond market was famously called the widowmaker, because people would short Japanese bonds because their debt levels went through the roof and continuously be carried out because it didn't happen. And I think you do bet against the US at your peril, but nevertheless, it's certainly not the environment that we've seen over the last, say, 30 years, where people were happy to park money in the US and happy to buy US Treasury. So it's going to become a bit more of an issue. Inflation has been talked about a lot. We have seen disinflation. It does look like inflation is heading downwards. Maybe it's going to be a bit sticky from here. I think over the longer term, we're probably going to see inflation be higher than we've seen over the last 10 years. So we're kind of back to the past, back to the future, back to the past, in that we're going to probably see inflation, whereas it continuously undershot since the global financial crisis in the US. The Fed did lots of meetings, lots of talking, lots of rate cuts, lots of QE, but couldn't get inflation above that 2% range, 2% level. I think we're going to start to see the opposite be true now, where they're going to put rates up, talk a lot, quantitatively tighten, but still struggle to get inflation down to that 2% level. And that means that we're likely to have US rates be a little bit higher than where they've been in the past. So yes, we've seen some return of inflation back down. It's not at those high levels that we saw a year and a half ago. But we're going to struggle. We're going to need to see rates at higher levels. The supply is an issue. There's a lot of debt, US debt coming to the market, and that's going to, very much like our market, it's going to require to be absorbed, and that's going to put pressure on that longer end of the yield curve. A lot of people have talked about US rate cuts. That is likely to happen. Obviously, the timing, etc., is up for debate. But that helps you in the front end. The longer end is actually highly dominated by the supply and demand for those securities. So they kind of exist in two things in the bond market. One is where's the front end, what's going to happen in the short end, and then what's going to happen in the longer end. The longer end is more around that supply and demand dynamics. And then the economic outlook, it's a mixed one. Mel talked about, are we in crash landing, soft landing, is there a landing? It's hard to tell. What you have in the US at the moment is continuous large budget deficits. The US, yes, most countries around the world had large budget deficits during COVID because they needed to support the economy during that period. But the US just hasn't been able to get itself off that drug of budget deficits and running and increasing their debt. If our friend Mr. Trump comes in at the end of the year, you could say that it's even less likely to get off that drug of trying, running large budget deficits. The US is growing. It shouldn't be running big budget deficits. It should be, those budget deficits should be declining, or at least, getting to flat. And what's happening is it's just too tempting politically to spend money. We know a lot about that story here in SA. So that's the US kind of backdrop. And many of the same dynamics are true in South Africa. We have seen some moderation in inflation. Our inflation was caused by different factors, whereas in the US, it was all about demand, guys taking those checks that were sent to them in the post and going out and spending. There were supply-side issues which did, to some extent, affect us. But all of that ended up with too much demand and inflation. Whereas in South Africa, a lot of our inflation is as a result of the problems that we've seen in our state-owned entities, inefficiencies, costs that are being put through to the system. Yes, we might see some improvement, but it's not something that just will go away with time. We tend to have stickier, higher inflation numbers. So, whereas I think we will see rate cuts in the US, but I think we'll see rate cuts down to a level that maybe that people don't expect, given where we've seen rates over the last 10 odd years since the global financial crisis, probably almost 15 years. The same will be true of South Africa. I don't think we've got the scope to make dramatic rate cuts. If we kind of think about this neutral real rate, it's kind of a theoretical level. Where should our rates be? I would contend that now US rate should be at about 1.5% above inflation. So if you think inflation is going to be 2.5, and the neutral real rate is 1.5, it's kind of new normal back to where we were before the global financial crisis. That's rates at around 4. In SA, again, we need to attract foreign capital. We need to have higher interest rates. We have had historically higher interest rates. If we have a neutral real rate of 2.5, 3, inflation gets down to 5, you're talking about 7.5, 8% repo rates. Yes, our repo rate's higher than that now, but it's not a huge amount that I would expect interest rates to come off. We talked a bit about that supply continues to be an issue. We're borrowing a lot of money. I was a little bit surprised last week at the budget. I had to reread it because when the budget came out, our SA bond market rallied dramatically. They loved all of the headlines, and I reread the budget, and I was like, I'm not sure I understand why our bonds are rallying so much. And then we saw a couple of days after the budget that the bonds completely reversed. They liked the headlines. They liked the fact that they were told that we're going to cap the overall debt to GDP. But the reality is we have had a long history of missing targets. We missed it this year. There's nothing that tells me in the behavior of government that they're going to get to, necessarily going to get to that to those targets. Sorry, Tian. And then we know about event risk. This year is an election year. We've had a budget. We've got the US elections, lots of elections around the world. So there's a lot of potential volatility that's going to come through this year. A brief slide. I thought I'd have one slide where our market income funds in general, so all my colleagues here will be happy, against other asset classes, and then kind of talk a bit about the objectives of our fund. I think historically you've seen actual good performance of income funds versus other asset classes because we do have higher real rates in this country. So we tend to have high interest rates. And what that means is that it crowds out other investment and it crowds out other investment classes. So, I would continue. I think we'll continue to see that. We'll continue to see high real rates. We've got high bond yields, volatile but high, and I think we'll continue to see allocations to the income fund sector. So, the multi-asset income sector has become a bit of a wide field of contenders, whereas you've got a lot of aggressive funds, you've got conservative funds, there's a whole range of different funds. What I try and do when I run the methodical income fund is really look at what are the objectives of the end investor. What is the end investor trying to achieve, and how can I help them meet that at the lowest possible risk? So I'm not necessarily trying to be the best fund in the sector, and we've seen of late some of the funds struggle as a result of pushing on the envelope there, but really trying to focus on what is the end investor trying to achieve. And I think what the end investor is trying to achieve are really two things. They want to beat inflation. That's relatively easy in South Africa. We've got interest rates that are substantially higher than inflation. It's not always been the case, because remember, during COVID, interest rates were brought down dramatically, and it was quite a tough period to beat inflation. But that's the focus of long-term investors in an income fund. You want to make sure that you're holding the value of the fund and growing it in a real way. And then you want to beat cash. You want to beat cash in this fund. So it's those two things. So, do you want a fund that's going to be, the best performing in a very diverse sector, or do you want a fund that does what the end investor needs out of the fund? And that's done by, focusing on the risk side of the. We've talked about a lot of these. I'm going to probably skip over this because we've talked about a lot of and other people have talked about it. So. Going back to the multi-asset income sector, it's a broad array of assets that you can put into these funds. You can put very high yield, very volatile assets, or you can put very conservative money market assets. So it's a whole broad range, and that's why I think it's a nice sector, because you do give the manager a lot of tools to be able to outperform. You're not constraining that manager in one particular asset class. But with that great freedom comes great responsibility. The manager needs to manage those risks, manage the risks around those different asset classes when constructing the portfolio. So I've got, it's a busy slide, I apologize, but these are the kind of asset classes that are available to us across the kind of money market and bond space. What I will tell you is that 3-month JIBAR is around 8.40, 8.4%. If you are earning more than 8.4% in a fund today, you're taking more risk than cash, okay? I'm not saying that's a bad thing. I'm just saying that there is no free lunch when you, in markets. You are taking additional risk. So, yes, there's value in bonds. Yes, there might be value in inflation-linked bonds. There might be value in all of these asset classes that you can put into property, all these asset classes that you can put into a fund. But as soon as you are putting other asset classes in, you are adding to the risk, and you've got to really manage that risk. This is our bond curve. It's been spoken about. It's very steep. There are opportunities on our bond curve, but it's also been very volatile. We've seen bond funds, if you look at bond fund returns, they've been extremely volatile. And income funds in general have outperformed bond funds because of that volatility. We've just seen a lot of volatility in bonds. So there are points of time when bonds offer extremely good value. But there are also points in time where a lot of the risks that should be priced in kind of get priced out. So you've got to be able to kind of manage those risks, and you want your manager to be taking advantage of that risk. It's quite hard for you to be doing that yourself. So you want to be looking at what are the risks around, what's the additional returns that you're getting, and what are the kind of volatility and risks that you're adding to the portfolio. This slide just showing the percentages are incorrect there. It just compares us to, I think Nolan talked about comparing us to US Treasuries. US Treasuries at 4%. How do we get from 4% to our bond yields at 11? Well, we're getting compensated for the risk of investing with the SA government. And we have to think about where does that risk sit currently in its terms of its pricing. Where is that priced versus where it's been historically, and what are the risks that are being priced in there, and what are the risks around that pricing. And then, what's the inflation differential? You're getting paid for the inflation differential, which is the currency risk. So when you're buying South African government bonds in rands, you're buying them in rands, you're not buying them in dollars. So you've got to think about all those risks. The spreads, if we look at global spreads, they are tight. They're tight versus where they've been historically. So we can argue whether our spread is pricing in too much default risk. But if I compare it to other if I compare it to spreads across time, spreads are tight. We've had a lot of money in the system. Markets have been, somewhat complacent about risks, and spreads are tight. So I don't think it's the environment. If you're buying things on spread, that it's necessary a time to be overweight spread. This is just briefly on the fund and how it's positioned at the moment. The fund is very focused on liquid investments, bank paper, government bonds. Somewhat controversially, I've got ILBs in there, inflation-linked bonds. It's not everybody. It's probably a bit of an outlier versus some of the managers, but I still think you're getting a reasonable real yield. Again, going back to what you're trying to achieve, you can get 4.6% real on an inflation-linked bond that matures at the end of January next year. That's a very attractive real yield. A lot of dry powder in the fund. We have seen a lot of weakness in bonds. It's probably a time to start, adding a little bit more in the bond space. That's how the fund's positioned. I think the last slide is just talking about the performance, and then the performance versus cash plus one and inflation. So that's again, focusing on what is important to the end investor. What's important to the end investor is beating inflation and beating cash returns by a reasonable margin. And you can see in red, red line is the methodical income fund since I joined. The black line is Steffi plus one, and the green line is South African inflation. So it's done what it said it would do on the tin. Thank you very much.
Ladies and gents, thank you very much for that. Any questions from the audience? Right, I've got a quick question. Well, it's not a quick question, it's going to be a loaded question, and it speaks to risks in portfolios, especially after recent events in the market. And I'm going to continue with Sydney's Afrikaans. Ek soek na 'n ander plan vir my plan, nee? So we know that there is a lot of assets in the market at the moment looking for safe havens where risks are being managed in portfolios. And JP, I think you made a very important point, and all of you may have addressed it partly as well, is how you get to where you need to be more than cash, and how you manage risks around those positions. And it's not always about being number one, because being number one sometimes means you have to take on more risks than what clients necessarily want. But specifically looking at your portfolios and composition portfolios, and I'm going to give each one of you maybe just a minute to reply on that, is how do you view credit in your income funds? How are you positioned with credits? And JP, you touched on some of those points. Spreads are thin. Looked at composition of your fund, but I want to go through all three of your funds. And then how do you potentially mitigate for default risks if you do have credit in portfolios? Melanie, you want to go first on that?
Yeah, it's such a good question. I think one that doesn't get much airplay because it's just a given, everyone has credit and we never see default. Yeah. So it's almost important that there is a default every now and then just to focus our minds on what credit risk is. So South Africa's credit corporate bond market isn't necessarily the most fertile hunting ground relative to offshore markets. So if you went to the US, you could trade different names. You could put a trade on today, exit it tomorrow. It says corporate bond market's getting a little bit more liquid, and there are more issuers in the market than there were, but it's certainly relatively less exciting. But you still have to think about it as any other asset class. So there are times when credit spreads are attractive relative to fundamentals. Those fundamentals will be where you're on the economic growth cycle and so on and so on. And there are times when it's tight relative to that. And what you can do is manage your credit exposure in two ways, your sizing of your credit exposure, but also your term to maturity. So if spreads are tight and you think that it's an unattractive environment, you're not getting compensated for risk, you bring your credit shorter. But it doesn't stop there. I think what makes income funds and fixed income funds in general quite different to equity funds is that in equity funds, you want to have concentrated exposures. You want to have your best ideas. You get equity funds, they've got the top 10 or the top 15. You think the opposite in fixed income world. We want to diversify as much as possible to minimize those risks. So you want to diversify across different issuers, across our entire universe, not just credit, but specifically in credit. And you want to diversify across maturities, so you don't have one single instrument that can necessarily impact your returns. So there's lots of diversification strategies that you can put in place. And I think that, in my mind, is the best way to construct an income fund composition where you don't have those individual hits that can completely wipe out all of the good work you've done with the rest of the strategies that you can put in place.
Thanks, Melanie. Sydney?
Yes, yeah, very interesting, and I think Mel's hit the nail on the head in terms of diversification. But I think credit is here to stay. We've seen it develop most certainly with my grey hairs, I've seen it develop over the years. And it's a market that is not going to just disappear or go away in a hurry because there's too much vested interest at the moment. I think the important thing is do your homework. That's important. Like any good portfolio manager, if you don't just buy on a whim or because the yield is great. And I'm seeing this in the market that people, let me just speak very broadly, are selling their souls for yield. I've got to get involved in it, but do your homework because there's risks of default, there's interest rate risk, there's the credit risk, there's all of those kind of things that you have to take into account when you get invested or you invest in a particular instrument. So Mel is quite right, diversify across, and our income fund is hugely diversified to bring down the risk. But also on top of that diversification, we also look at the quality of the credit, and we do our homework in terms of credit analysis as to what goes in the portfolio and what does not go in the portfolio. I said it earlier, and I think JP said it in a different way. We manage expectation if we can give you. So don't go and put something in your portfolio which is contrary to the objective and target of your fund. So if I'm going to give you Steffi +1 or Steffi plus food in my 2, let me get it right, then your investment must match that in credit as well. And of course, because then you are managing the risk. Yeah, I could go on for a while, but let's give JP
Thank you,
a
JP.
chance.
It's lovely to see the passion.
Yeah.
Exactly.
Yeah, I mean, I would say, maybe slightly controversially, well, I think there's a couple of things that happen out of this. I think, our credit market lives in an exchange control bubble, so it doesn't really move along with global markets. So where Mel was talking about global corporates, if I trade a South African name in the dollar market, it moves around points at a time in a day. If I trade it in the South African market, it never moves, or it moves, by fractions. So there has been a very seductive situation in SA credit, which continues to this day, that it is, from a Sharpe ratio perspective, fantastic because you're getting additional returns without the additional volatility, and you don't really see that risk in a day-to-day. In fact, I had a client yesterday say, "I can't believe this, this blow up because this guy's being top quartile every." I'm saying, well, that's exactly how it works, because you reap a lot of additional return for a period of time, and it's only when you have events happen that you see the risks that you're actually taking. I, as a fixed income manager, and somebody's running a fixed income franchise, see it as a threat to my business, because what happens with a lot of advisors such as yourselves, they will stop giving us the income funds money. I'm not talking about my fund in particular, because the end clients will say, well, I can get 9% in a bank, Standard Bank or ABSA will give me 9%. And I don't have all of this, I don't have to understand all of this nonsense that you guys are putting into your fund. So, that it does create a bit of a risk. I think South African credit is a little bit, I think it's been overpriced for a long period of time, as an asset class. And so I don't actually have any money outside, in kind of corporate credit.
Good. I think that answers that. And I mean, very important to the audience out here. I mean, all three fund managers, good solid track records in managing risk and managing fixed income. So Melanie, Sydney, JP, thank you so much for being here today and sharing your views. Really appreciate it. Good
Thanks.
stuff.
Good.
Right. Our last session for the day, always a lot of excitement, multi-asset funds. Welcome to the stage is Nseke Molua from Vunani Fund Management, Paul Bosman from Granite Asset Management, and Jacobus Kok from Fairtree. Right. I always say multi-asset funds, I really do like it. You can come up so long, it's fine, no problem. Because this is where everything comes together. Onshore, offshore, more risk, less risk, more fixed income or less fixed income. Right. This is the time to chat through it. And again, we're going to take a couple of questions afterwards. Paul is here. Jacobus? In the mic. Right. While you're miking up, I'm going to continue so long, and you can just come through to my right-hand side when you're ready. And Nseke, you're up first. If you are ready, you are more than welcome. Left, right, and point. Good stuff. Thank you.
I was sitting here just nodding my head and wondering if I was nodding my head at the comments that the previous panel was making, because in a previous life I was also managing fixed income funds. But then I realized also during JP's presentation that it's also because really multi-asset funds that we're going to discuss are just an extension of this same spectrum. So looking at a variety of asset classes, perhaps the sizing in certain asset classes becomes greater than in others. But I think without trying to repeat what has already been said, maybe just to ask ourselves, what is it that we have seen as Vunani that has struck us about the markets so far? I mean, one of the things that's been quite striking is the fact that for all the talk about hard landing, soft landing, the uncertainty that comes with that, there's been almost a very relaxed response in certain other markets, risk sentiment markets. So what you have before you is a classic one looking at the put-call ratio, or the VIX is one that many people will be familiar with. There's nothing particularly striking about them that says that a risk is elevated, although Melanie did speak about, for example, geopolitical risk being elevated. We do know, however, that interest rates have been rising. And if we take the example of the United States, we know that larger corporates are able to access a very liquid market. They're able to manage their interest rate exposure by issuing corporate bonds in a very deep and liquid market. However, the smaller businesses are not able to do quite the same thing. And so they're much more exposed to the fact that interest rates are rising. So that's something we bear in mind. Remember, these are businesses that are probably the largest employers of Americans in the nation. So you do expect that to play out in some way. And the most obvious way you expect it to play out is in the labor market. So while we've seen that government employment in terms of the addition of incremental jobs has been relatively stable, so that's the solid blue bar at the bottom. We've also seen fairly healthy job growth in areas such as healthcare. But in other private sectors, you've seen a gradual diminution of the addition of jobs. And that's to be expected in an environment where costs for business, for doing business, are inching up. One of the other things that we've also noticed is the fact that the upside surprise to earnings has been edging lower and lower. And this, historically, leads to risk-taking sentiment rather, beginning to edge lower and lower. So these paint a picture for us of a developed market environment that is gradually slowing down. Thinking about things locally, there's nothing really that I have to say that is a great surprise, but I think one of the things that's rather interesting is how South Africa and South Africans have been very adept at making a plan. So while in one of those charts, in fact, the middle one at the top, you see that the extent of load shedding seems to have been coming down. It might be contentious given the warning we were given coming here that load shedding is rather terrible. However, if you look at the bottom left chart, you will see there that the intensity of electricity in GDP has actually been coming down. And that's been because we've been so adept at making a plan and putting solar plants on every roof and wind farms as you fly over the country. So the interesting thing about the local market or the local economy is that growth remains low, as Mel said, and that is a risk. We really do need to see the growth rate beginning to pick up. But we have so far managed. It's not that we will manage forever, and we just need to be mindful of that. So as managers, what do? We know what we know, and there's a lot that we don't necessarily know. But one of the things that we can do to bring some level of insurance into portfolios is to make sure that we're not overpaying for our assets in the first place. So starting valuation does tend to matter. And if you map it over time, generally speaking, if you're buying assets at low multiples, you're more likely to see a higher return over time going forward. That's true in the US, and so what we have here is the S&P, but you pick it up as well in South Africa. The principle is the same. When we look at what does actually matter over the long term, it is earnings for equity instruments. And so when you map over time what the indices have done, whether it's the S&P at the top or the JSE at the bottom, you tend to expect that over time price will behave as equity earnings behave. But the particularly interesting aspect of this chart that I want to draw your attention to is that although there's often lots of talk about how cheap assets are in South Africa, if you look at that bottom chart, you will notice that the golden line is beginning or has caught up to the price line. And that makes you pause for a second because it suggests that, well, assets are relatively cheap, but it's because they needed earnings to eventually catch up to where they are. And in a sense, that does make sense if you're looking at assets that are operating in an environment that is strained economically. So just a point to keep in the back of your head, South African assets may be cheap, particularly on the equity side, but is there a reason for that? When we look over on the fixed income side, unsurprisingly, and the previous presenters would have alluded to it, higher interest rates, yields to maturity, are usually a good starting point with the idea that hopefully they don't go higher, but rather lower. And I think Mel also showed you a chart of how you can see interest rates, how you can earn returns out of the bond market, even if interest rates edge up slightly, but how much better they do if they edge down a bit more. So a higher yield is better for you. JP alluded to this. In the local market, we've been seeing very good returns where cash rates have generally been above inflation, except in certain stressed environments. and this is attractive. So what it means for us in portfolios is that when you see cash in your multi-asset portfolios, it serves a useful dual purpose. It not only dampens the volatility of your portfolio, but you can still get an above inflation return from that, which is a positive thing. And then I'll just begin to round off with a few thoughts about where we are in terms of pricing. If you look at the equity risk premium, which gives you an indication of how fairly priced equity assets are, you'll see that while in the US, the equity risk premium seems to be hovering around its long-term average, in South Africa, it's actually rather the opposite way. In the US, it's below its long-term average, which means it's probably trading a bit rich relative to history. But in South Africa, it's closer to its long-term average. So, we're seeing South African equity assets looking like they're more or less fairly valued. I would caution against those who say they are a dripping roast. Close your eyes and buy them. They seem to be fairly priced. However, in offshore markets, you're seeing something of a richer taste to where equity assets are. In terms of broader asset class expectations, these are often modeled over longer periods. So you're talking about probably a 10-year period. And the ordering of them is not terribly surprising, but perhaps what might be surprising to you is that expected returns in South Africa seem to be a little bit better than they would be in offshore markets. We don't have it right here, but they're probably closer to about twice where you'd see them there. But what's interesting is that nominal bonds, for example, which is what we've heard quite a bit about, although their expected returns are not as strong as equities, they do give you considerably less volatility. And so on a risk-adjusted basis, they are an asset class not to sneeze at. So how do we at Vunani take these insights and bring them up into a portfolio, to construct a portfolio? What we have done is we've gone back in time. We've looked at historical returns. We've looked at moments where there were substantial reductions in markets, and then classified those periods as periods of stress. In other words, periods where you want to be mitigating risk. And then we've also done the same and said, where were the periods where we found that markets were very frothy, incredibly optimistic, and we've bucketed those as well. And then everything else we consider to be a normal environment. We've run some optimizations, is what we call them, on those different buckets, and said, you know what, if I had held this type of portfolio mix during that period, what would have been the best mix to have held? And so that's what we have done, and we have done it such that if you were trying to pursue a CPI plus 3, a CPI plus 4, CPI plus 5 target, you have actually a sort of a model to work towards. And this has been very helpful in the day-to-day management of the portfolios. It allows you to move to particular mixes of the of asset classes as and when risk sentiment shifts. So that's how it's been. At Vunani, we have a fairly young fund in the multi-asset space on the BCI platform. However, as young as it has been, our management of multi-asset portfolios actually stretches out more than 2 decades with a track record that has been useful, I hope. So do take a look on the BCI platform, and just bear in mind as well that there is a longer term history of managing these types of portfolios. Thank you very much.
Thank you very much, and thanks for the opportunity today. So during my third year at university, I remember staring at 2 green boards full of mathematical derivatives. At some point, the professor stopped. He turned around, he looked us all in the eye, and he started throwing the chalk from hand to hand, slowly. And he said, "Folks, what's the hardest thing on the face of the earth?" And there was this long silence, and he said, "To change." And he carried on. And for me, at that moment, I thought the hardest thing on the face of the earth was written on the board. But in subsequent years, many, many years to come, I've realized that I actually learned 2 lessons that day. The first one being that timeless truths are very simple, and the second one being that the hardest thing on the face of the earth, in fact, is to change. So when we built Granite, we built it in a way that we never have to change who we are. We don't one day want to say, this is not the Granite that we want it to be. So who is Granite? Very simple. It's a group of people who've come together to do the same thing in the same way, the way we want to do it. And that is, we want to look after client savings, we want to protect and grow those savings. We work as a single team around a shared set of values. One of those values is simplicity. So what does simplicity mean? How do you actually live this value, simplicity? We say always start with the simplest question. You can always break something down by saying, okay, I've asked something, I don't quite understand what I'm asking, let's go back, until you ask a question you've got to answer for. So when it comes to investing, what's the simplest question when investing? What are the timeless truths that over time, over many, many years, I'm talking centuries, have worked in investing? So I want to know what all these people have in common. We've got Bill Gates from Microsoft, we've got Jeff Bezos from Amazon, Michiel Roux from Capitec, Steve Jobs from Apple, John Malone from Liberty Global, which was a cable TV empire. That's one of the companies, but he effectively established large companies that operated in cable TV, initially in the US and globally. Peter Maersk-Moller, that was the first family to do long-haul shipping by means of steam propelling, which you naturally still see the name around. Giovanni de Medici, you might not know, he is, the Medicis have been dead for a long time, but their money is still around. They effectively formalized banking in Europe during the 1500s. And then Sam Walton from Walmart. Of course, they're all rich. That's not the point. They did something very unique. Every one of them built a competitive advantage, which is a durable competitive advantage, on a multi-decade growth vector. So whether it's smartphones, whether it is home delivery of goods, so not going to the mall, whether it is enterprise and personal computing software, whether it was cable TV, whether it was shipping, banking, or the supermarket concept, which Sam Walton actually established, those were multi-decade growth vectors, and they had some form of durable competitive advantage on that. So a very simple answer to our first question is, look for durable competitive advantages on strong growth vectors, and then don't sell it, because the PE is 20. So remain invested. Every time you sold Capitec at a PE of 20, you were wrong. I've been wrong a few times. Is there another timeless truth? There are emotions in markets. If we think of examples how we could have harnessed those, you could have bought during the great financial crisis, you could have bought during COVID, but then there have actually also been a few industry-specific opportunities. It doesn't always have to be these macro sell-offs. Let's look at an example. The previous resource cycle ended rather violently in 2015-16. If you had exposure, you'd still remember it very clearly. It's almost now 10 years ago. It's imprinted in my mind. I'll never forget it. There's no substitute for experience. Anglo American went down to 18% of book value. That's unthinkable now. The prices that were being priced into the share price, the resource prices that you needed to justify that share price, was not possible. If resource prices stayed there, there will be no mines, and commodity prices will be so expensive that Anglo American cannot be worth 18% of book value. But there was one catch. You couldn't just buy it, because Anglo American might not have survived. The balance sheet was weak. So it took some bravery to buy it. So when you're harnessing this emotion, there's another dimension to it. You can only harvest emotion in markets if you buy entities that are very unlikely to fail. So not being contrarian, not being value investor, buying when there's negative emotion, but buying companies that are very unlikely to fail, because you don't know for how long those challenges can persist. For us, there are basically 4 ways in which companies can fail. The first one being naturally the balance sheet is weak. The other one being lacking governance, poor management. All these competitive forces erode, which is where we started. You need to understand how durable the competitive advantage is and remain invested for as long as that competitive advantage is in place, but not for longer than that. So our whole process is designed to try and avoid these companies that can fail through one of those 4 pillars. If we believe the company can fail, we don't invest, regardless of the price. It's called the value trap, which we try and avoid. So are there examples? These are great examples of historic truths. Are they currently examples? This is the biggest position in our fund. We believe that Taiwan semiconductor manufacturing company has got a durable competitive advantage on a strong growth vector. This is the earnings per share over the last 20 years. It's compounded at high teens. What is the competitive advantage? They're making very, very small semiconductors. If you look down at your thumbnail now for a second, no one's done it, please look at your thumbnail for a second. Your thumbnail has grown more now than the size of the semiconductors they're making, 2 nanometers. It is a competitive advantage that is very, very hard to replicate. So we see a durable competitive advantage, and we think this industry will continue growing. Okay, an example of the second truth, these opportunities through emotions. There remains tremendous negativity in property at the moment. So you could say that resource opportunity was phenomenal. Why don't we all fill our boots with Anglo-American? We didn't. Well, the good news is the opportunities today, property. How many of you have got a lot of property? Not many, because it's not that easy. So this is a company, Unibel Rodamco Westfield. It was very popular during the property boom. It traded at 70% premium to book. That book had been written up many times, and it trades at a premium to that book. Your dividend yield is 2.5%, but everybody wants to own it. I don't know why. Then the property cycle unwound, and then book values got written down, the dividends got cut, and it traded at 30% of the written down book value. Now that's gone up to about 55% of written down book value. Its dividend yield is double digit. Its balance sheet is structured in such a way that it will survive even if interest rates remain high for 5 years. The balance sheet will survive. So what I said about Anglo-American, that was hard to call at the time. We were a little bit brave at the time. This requires less bravery. You can see the debt is fixed, and they're very well positioned. Shopping centres are not very vacant. They're in a very strong position. The only thing that hasn't recovered is the share price. So the only lesson today that I'm hoping, I don't have 2 boards full of formulas, just granted we use timeless principles when investing.
Great. Thanks, Eugene and team, for this opportunity. I'm going to talk about the balanced fund strategy, and in particular the Select BCI Balanced Fund, and how we think about asset allocation within the current macro environment. Let's go for all these family photos. Looking good. Right. So I'm Jacobus Lecoq from Fairtree. We took over the management of the Select BCI Balanced Fund in November 2020, but we've been managing the strategy since 2017, so almost 7 years. In terms of the fund, what it tries to achieve is 3 very clear objectives. First of all, we focus our strategic asset allocation in providing capital return, capital appreciation, so CPI plus 5. That's what we aim for. We believe tactical asset allocation is predominantly there to protect against the crash. And then I think very important is in this current environment, we have specialist security or portfolio managers focusing on each specific asset class. We believe in this environment, which you heard about today, of higher for longer, so rates will be higher for a prolonged period, there's going to be dispersion in the market, more so than we had seen in the last decade, between sectors, between countries, between stocks, and I think stock selection is key in that environment. So this is how we've performed relative to CPI plus 5, outperforming that CPI plus 5 target 90% of the time, 99% of the time, giving you above inflation returns. In terms of when we've been managing the fund, outperforming the peer group, haven't done so well over the last year. We've been underperforming the peer group, but we believe we are well positioned for the next 12 to 18 months in terms of the environment which we think will play out. We've been, I think, too early in some other themes. And I'll talk you through the way that we see the world now and how we think things will transpire. So we look at the global PMI as a way of gauging where we are in the economic cycle. And we break it up between the manufacturing and the services sector, manufacturing being the smaller part, more cyclical, services being the bigger driver of the global economy, but slower moving. What you can first see is that we have been in a manufacturing recession for the last 18 months. Remember, people after the pandemic went from buying goods to buying services, and as a result, those goods inventories built up, and due to the fact that the consumer remained relatively robust, we had some of that spending taking place still, and now some of that inventory is being worked through to the extent the manufacturing cycle is starting to increase again, is starting to improve again. We don't expect a strong recovery in the manufacturing cycle, but when you do get a manufacturing upturn, it is important for the likes of the US dollar. The US dollar is a counter-cyclical currency, so we think in this environment where we potentially see a bit of a rise in manufacturing, it can potentially put the dollar under pressure. Then, surprisingly, we've had an uptick in the services PMI. We thought that the services PMI is going to continue to drop, give us softer growth potentially in the future, but we saw an uptick more recently. Was that because the Fed got too dovish prematurely? That's a question. And the question now is, are we seeing a re-acceleration into a no landing or soft landing, or is this just a bump in the road on the way still to a recession? Well, to answer that question, we look at the monetary policy backdrop for the last 40 years. So you can see the orange line there shows you the Fed rate over the last 40 years or so, and then recessions in dark. There's three things that I want to maybe point out from this. The first one is this has been the most aggressive hiking cycle that we've seen in our lifetimes, well, in my lifetime. We've gone up from 0 to almost 5.5% in a little bit more than 12 months. We've gone up to 5.5%, way above the 2.5%, which the Fed believes is the neutral policy rate. And many in the market, including some of the speakers before me, think it's around 3, maybe 4%. So far above that, we are clearly in restrictive territory. And the third thing is, if you look at prior cycles, you can look at the yield curve. Just use a very simple metric here. How long does it take from the last rate hike by the US until a recession hits? It can take 18 months. We're only 7 months down the line at the moment. So to talk about no landing, I think is premature. We have to wait to see how long, or it can take long, before monetary policy works its way through the economy. So with that in mind then, I think it's prudent to become more defensive in your portfolios. But because it can take still months, maybe a couple of quarters or more, before we hit some sort of and we think it's a mild recession, so not a hard landing, a mild recession, so you're close to 0, maybe slightly below 0 for a couple of quarters. Before we get there, you still have to find opportunities in the market. You can't sit within cash. We saw just now there are many asset classes that has outperformed cash over the last year. So you still want to be focused on where can you find opportunity in this market. And often there's deep value opportunities in emerging markets at the moment, like China and like South Africa, and I'll talk about that maybe later. So in terms of the US, what are the things that you need to follow? Most importantly, we think you need to follow now, in this part of the cycle, what's happening with the labor market. And if you look at the first Friday of every month, we get the non-farm payrolls number, and surprisingly, it has been quite strong for the last few months. Yet, if you go through some of the other labor market statistics, and we've just had the small business index here, which is a big employer of labor, showing that weakness. But apart from that, the quits rate, people aren't quitting as fast as they used to in the past because they don't feel confident that they can get another job. companies aren't hiring as fast anymore, and this chart shows that temporary layoffs have started to increase. Temporary jobs is typically the thing that you cut first before you cut your permanent jobs, and that we see those layoffs have started to increase in the US, which tells us that things aren't yet screaming that there's no landing taking place. This saying, from an economist in economics, things takes longer to happen than you think they will, and then they happen faster than you thought they could. I think that's very relevant in the world we're moving in at the moment. 3 months is a long time in the market. So, what's happening on the inflation front? The disinflation process that started 12 months ago or so, we think has almost run its course. Most of that has really spurred the market on as the Fed started to talk about cutting interest rates. We're getting to the end of that disinflation cycle. There's a bit more to go, but we're seeing signs that in the US in particular, inflation is sticky. We may not get down to the 2%. We think you can't get down sustainably to the 2% unless you have that softer recession or some form of recession that will get inflation there. It's different in Europe. Europe is already going through some sort of a mild recession at the moment. And therefore, we see inflation dropping faster. They'll most likely, the ECB will be able to cut earlier. And China is the one at the moment that's exporting deflation to the rest of the world. But we also think, due to this, the PBOC and authorities in China is in the best position to actually stimulate growth. Maybe they're just waiting for the US to go through some soft patch. And as a result of that, we think that China could potentially provide some recovery in the future. So where does this leave the Fed? The black line shows what the Fed has done. The orange line shows what the market thinks where rates will be by the end of this year. So you can see just in the last few months, the market has started to price out potential cuts to only about, I think, 3.5 at the moment for the rest of this year because of the stronger data, because of the sticky inflation. But as I said, I think it's just a matter of time before the Fed will move from acknowledging that inflation is sticky and therefore they can't cut to they have to cut because growth is soft. And I think that is the next leg of this of bonds yields moving lower and rates moving lower. It's not going to be inflation driven, it's going to be growth data driven. And there's this lagging period in between that we have to get through. In that environment, I think you want to be overweight bonds, you want to be overweight global bonds, SA bonds, and also gold. As you see real rates coming down, it should be beneficial to gold. What about the emerging markets? Well, again, looking at the PMIs, there's a better outlook for them relative to developed markets. They are in a better position to actually cut interest rates. They don't sit with the same inflation problems that the developed markets are sitting with. Remember, those were the ones that actually stimulated demand during the pandemic, supported demand, and now having to sit with the consequences of that. Many emerging markets weren't in the position to do so. In fact, many of them have supported the supply side. But the fact is that EM is in a better position potentially to stimulate growth, most likely to benefit from a weaker US dollar, as we said, and also from a manufacturing cycle that's starting to pick up. So China's, and I think there's some speakers who spoke about China earlier on, so I'm not going to say too much about it, but the fact that it's clear that their confidence is very low amongst consumers. And the reason for that is because a lot of their wealth is locked up in the property market. And unlike the bank, we can go to the bank and do a run on the bank and get your money back. You can't go to the property developer and say, I want my money back. He says, wait, I'm going to give you your apartment, but I don't have funding at the moment, so we'll sort it out. But it maybe take you a year, 2 years, 3 years. And that's what's playing out at the moment in China, and why consumer confidence is extremely low. But again, if you look at the deleveraging cycle on the left-hand side, it's floor space that has been started on a 12-month rolling basis. We are a long way through the deleveraging cycle already, since the 3 red lines were announced back in 2021. In fact, if you just take this graph on a monthly basis, it does look like for the last 3 to 6 months we've started to stabilize. The floor space started to stabilize at the level at about 750 per over a year basis. So I'm not saying we are there yet. I'm just saying we can see that that duration is slowing. On the other hand, you see floor space being completed. So people are actually getting their apartment now, which they've been waiting for a while. That has started to pick up. So slowly but surely, the property sector, I think, is mending to some extent. We don't see it in all the numbers yet. Sales are still very weak. And we see a lot of property easing measures that has been announced, from rate cuts to decreasing your amount of deposit you have to put down. Not a lot of that has actually come through the market just yet, but we think ultimately it will start to support the economy at some point. If we look at the most recent activity numbers, and this is just from China's Lunar New Year a couple of weeks ago, how they've traveled. It's typically a measure you look at how they've traveled and spent in this Lunar New Year relative to last year's Lunar New Year, and things are looking better. In fact, it's looking better than 2019. Total passenger traffic is up 20 to 30% relative to 2019. Per capita spend is up 9% relative to 2019. So we see some improvements already taking place. I'm not saying we're turning the corner just yet, but we are very much focused on monitoring what's going on in China. And slowly but surely, I think relative to what's in the price, things are starting to look slightly better. In fact, I think month to date, the CSI 300 is up more than the Magnificent 7. Right, so let's just finish off with South Africa. Many speakers spoke about how attractive valuations is in South Africa. The thing is, you need some sort of a catalyst to unlock that value. And I think there's 3 catalysts that's playing out at the moment that we will see over the next 18 months can unlock some of this value that sits in the market. The first one is playing out at the moment. We are seeing less load shedding this year relative to last year. Corporates that had spent a lot of capex last year on diesel generators, on investment, has hurt their profit margins. That won't be repeated this year, so you could expect some of those profit margins looking better this year relative to last year. The second thing is, as inflation continues to come down or remains around these levels at 4.5%, the SARB will be in a position to start to cut rates later this year. And we think maybe early in the second half of this year, they can start to cut interest rates. And yes, by about 100 basis points, maybe at least. Potentially more if we do see that soft or recession scenario in the US also playing out. That will start to provide some easing to the consumer. And thirdly, it's around the elections. Now, I think we would have a political speaker here later on, so I was going to leave him to speak all about this, but I'll just say 2 things about the elections. If we speak to foreigners or if we hear about how foreigners are thinking about SA and the elections at the moment, there's 2 things that they want. They want to see change to a better growth outcome, and they want to see certainty. So what are the hurdle for that? What is the hurdle to get us there? I think the first one is the ANC got 58% in 2019. If you told me then that they will fall below 50%, I would say probably not yet. Yet political analysts are talking about maybe 45%, some saying even below the 45%. So we are seeing change happening. We are seeing people voting for change. The second thing is they want certainty, and there the hurdle is if we get an ANC government-led government with anyone but the EFF, there will be improved policy certainty. And I think that is the second thing which they want. And in our mind, the likelihood of the ANC and the EFF collating is fairly slim at this stage. So the elections could be a very important catalyst to bring back foreign investment back into the country. Not a flood, but starting to trickle in some of that investment that's sitting on the sides at the moment and saying we first want to see how this movie plays out. Lastly, this is how we're positioned at the moment. So you can see underweight equities overall, overweight bonds, tactically underweight SA equities at the moment. We think it will provide a better opportunity set later this year. In property, global and SA, we were overweight towards the end of last year, just from a tactical perspective, driven by bond yields moving down. We moved back to neutral to slightly underweight. Overweight commodities, in particular gold, and also overweight SA and global bonds. Thank you.
I know you are dying to get to lunch, but now is the time to ask those questions you wanted to ask all day long. Even Tiana's quiet. Right. I think I'm going to end that session there, but maybe just a couple of quick thoughts. Gents, you are staying for lunch as well, so if anybody wants to talk to you afterwards, more than welcome to do so. On the Fairtree side, I mean, Fairtree managed a couple of select mandates, if you want to talk to Jacobus about that, and their repositioning of their equity carve-out. I found it very interesting what happened in 2023, how you were positioned beginning of the year, how you are positioned now. So definitely a fund manager that does reposition when they need to. Paul, a lot of property exposure in your mandates as well. Very interesting. We're going to talk to Paul about property, why property, SA and global. Very strong numbers. And also very interesting is you don't have an SAA framework, which I find very different to a lot of other managers out there. Right. So talk to Paul about that. And on the Vunani side, thank you very much. Your fund very new. You didn't mention the fund name, the Vunani BCI Multi-Asset Fund. Are we not allowed to say that? I'm not sure. Right. So that is the fund that is referring to. It's got a longer institutional record, strong management team as well, and a couple of other individuals in the business been going for a very, very long time. So please have a conversation with them about their funds over lunch. Very interesting, full of insight. From my side, thank you all for presenting here today, coming through today, and all our presenters here as well. I see some of them still in the audience. I don't know if they're still catching tips from the other managers. You never know. To you, our audience and our supporters, we remain ever grateful for your support. And thank you so much for joining us here today. Keep an eye out again for March, Boutiques on Wednesdays, the online webinars. We're going to start that first week in March. We're almost there. And last but not least, the BCI team, Amelia, Olga, Tanya, thank you all for arranging these wonderful sessions. We're very grateful. And we'll chat to you soon. See you on the BOWs. Thank you.